Welcome to the complete Forex trading guide for beginners course. My name is Gerrit Gerber and I will be your trading instructor throughout this course. I am a civil engineer / Forex trader from South Africa with over 3 years of trading experience in the Forex markets. This course is made up of everything that I learned over my 3 years as a trader and is compiled into 8 easy to understand lessons for anyone interested in Forex trading. In lesson 1, we will take a look at the Forex fundamentals and discuss exactly what Forex trading is all about. In lesson 2, I will show you exactly how to analyze and interpret different Forex charts using various technical analysis tools. In lesson 3, we will be looking at the fundamental side of Forex trading, including the economic events that move the Forex markets. In lesson 4, I will show you how to successfully navigate the 2 most popular trading platforms, namely MetaTrader 4 and TradingView. Lesson 5 will contain everything you need to know to create your very own trading plan. Moving on to lesson 6, where I will teach you 3 trading strategies to successfully navigate the Forex markets. In lesson 7, we dive into why psychology is the most important part of Forex trading. And lastly, in lesson 8, I provide members of this course with some added bonus content. If you are ready to take the first step, then enroll in this course today and learn to master the art of Forex trading. Hello guys, and welcome to the very first lesson in the complete Forex trading guide for beginners course, an introduction into Forex trading. And to start you guys off on your journey to mastering the art of Forex trading, I thought I'd share with you guys exactly what is Forex trading in this very first lecture. Now, Forex trading is a conversion of one currency into another. For example, converting American dollars into British pounds or Australian dollars into Japanese yens. So in essence, it's a conversion of one country's currency into a different country's currency. So just imagine for a second you are planning a trip overseas and you will be traveling from America to London. Now, when you arrive at London, you realize that you need to exchange or convert your American dollars into British pounds in order to spend money in London for the duration of your trip. And in order to convert your American dollars into British pounds, you make use of something called a foreign exchange rate between the United States and the United Kingdom. Now, each country has its own unique foreign exchange rate with a different country. For example, the USA has its own foreign exchange rate with the United Kingdom, with Australia, with New Zealand, with any other country in the world. Likewise, Australia has its own foreign exchange rate with South Africa, with China, with Japan, with any other country in the world. So in order to convert one country's currency into a different country's currency, you need to make use of something called a foreign exchange rate. Now, this foreign exchange rate is continuously changing, it's continuously moving up and down through the market, and the Forex traders analyze these movements, these changes in the foreign exchange rate between the 2 countries, and they can determine with a certain degree of accuracy by performing technical analysis on the movements of the foreign exchange rate whether this exchange rate is likely to increase or decrease in the next hour, in the next day, week, or even year. And that is how Forex trading works. By trading the movement of the foreign exchange rate between one country and another one. Now, the Forex market is the world's largest financial market with an average daily volume of 5 trillion American dollars versus 500 billion American dollars for the stock market. So it's the biggest and most rewarding financial market to trade. Now, the Forex market is open 24 hours a day, 5 days a week, Monday to Friday, and is closed on weekends. And to be a Forex trader enables you to trade from anywhere in the world. All you need is a laptop, a smartphone, and an internet connection. So you can literally trade from the beach, from the hotel, from anywhere in the world for 5 days a week, 24 hours a day. And that's the power of Forex trading. Now, there are 4 major worldwide trading sessions throughout the day, known as the Sydney, the Tokyo, the London, and the New York sessions. And these sessions overlap throughout the day. So for the 5 days a week, you have your 4 different sessions. So depending on where you live in the world, you can use this table to determine which session starts for you at which specific time, whether it's EDT time, EST time, BST or GMT time. You can determine your specific time frame for the different sessions throughout the world depending on where you are and where you are living in the world. Now, in my experience, the best time of day to trade, where the markets are the most volatile and moving the most, is with the London Open and the New York Open. And like I said, depending on where you live in the world, by making use of this table below, you will know exactly when the start of the London and the New York sessions begin, and you will be able to perform your analysis and be able to trade the foreign exchange rate for any country into another country's currency. So that is just a quick introduction into what is Forex trading, and I hope I gave you guys a clear indication of how the Forex markets work. And thanks for watching this introduction into what is Forex trading, and I'll catch you guys in the next video. Bye bye. Welcome to lecture 2, Forex Basics. In this lecture, we're going to expand into the Forex fundamentals and increase your knowledge of Forex trading and the Forex markets. The Forex market, otherwise known as the foreign exchange market, is made up of different world currencies, each currency being displayed as a 3-letter symbol. The 8 most common currency symbols in the Forex market include the Euro, the American dollar, the Great British Pound, the Japanese Yen, the Canadian dollar, Australian dollar, New Zealand dollar, and the Swiss franc. All 8 of these currencies contain their own unique 3-letter currency symbol, and the American dollar and the Euro are among the 2 most traded pairs in the Forex market. The Forex market is made up of various currency pairs, with each pair consisting out of a combination of 2 currencies. Remember, you are exchanging one currency for another. For example, the American dollar versus the Japanese yen. You are exchanging American dollars into Japanese yen, or the New Zealand dollar, Swiss franc, where you exchange New Zealand dollars into Swiss franc, or the Australian dollar, Canadian dollar. These are all examples of different currency pairs that you'll find in the Forex markets. The most traded Forex pairs, or the majors in the Forex market, all include the American dollar currency in the pair. And these pairs are the Euro USD, the Pound USD, the Dollar JPY, the Australian Dollar USD, the Dollar CAD, the Dollar SHIFI, and the New Zealand USD. They are also known as the majors. And all the pairs that don't contain the American dollar in them, like the New Zealand dollar, Swiss franc, or the Australian dollar, Canadian dollar, are the minor pairs. So the Forex market is made up of the major currency pairs and the minor currency pairs. Each currency pair consists out of a base and a quote currency together with the pair's own exchange rate. For example, the Euro against the American dollar, with the Euro being the base currency or the first currency in the currency pair, and the American dollar being the quote currency or the second currency in the currency pair. And you will typically see this currency pair like this. The euro versus the dollar, and then its own unique exchange rate at that time. For example, the 1.08552 is the Euro USD's exchange rate at that specific time. And remember, this exchange rate is changing continuously during the day when the forex markets are open, and in essence that is what you'll be trading. You can either expect the exchange rate to increase and you can buy the euro against the dollar, or you can expect the exchange rate to decrease and you can sell the euro against the American dollar. The exchange rate indicates how many units of the quote currency you receive with 1 unit of base currency. In this case, 1 euro is equal to 1.08 US dollars. If you want to buy 1 euro, you have to pay 1.08 US dollars, or if you sell 1 euro, you will receive 1.08 US dollars. And that is what the exchange rate is used for in the forex markets. Hopefully that will make some more sense later on in this course. And that concludes our lesson for today. See you guys in lesson 3. Thanks for watching. Hi guys, and welcome to lecture 3, popular forex terminology. These are some of the terms that are used by traders throughout the world to describe the different aspects of forex trading. And the first term that we are going to be looking at today is a pip. And this is probably the most widely and most popular forex term that you'll hear when you talk about forex trading. A pip, otherwise known as a price interest point, is a unit of measurement showcasing the smallest change in price for any given currency pair. A pip is usually the second last decimal of a price quote, with the last decimal representing a pipette or a fractional pip, meaning a tenth of a pip. Most brokers quote currency pairs in 3 or 5 decimal places, with all of the Japanese yen pairs being quoted in 3 decimal places. Now, here is 2 examples of currency pairs that you'll find in the forex markets and the individual price quotes, namely the Euro USD with its price quote of 1.08452 and the dollar Japanese yen with its price quote of 107.185. As you can see, the Japanese yen pair has only 3 decimal places, there's only 3 decimal places here, and the other currency pairs contain 5 decimal places. Now, the pip, like I said, is the second to last decimal place in the price quote, and in this example the 5 is the pip value of the Euro USD and the 8 is the pip value of the dollar Japanese yen, with the fractional pip being the red value of 2 in the Euro USD price quote and 5 in the dollar Japanese yen price quote. So the pip is always the second to last decimal place in the price quote. Now let's say, for instance, the price of the Euro USD changes from 1.0845 to 47, then that would be a change of 2 pips. And if price decreases from 45 to, let's say, 41, then that would be a decrease of 4 pips. And we don't even consider fractional pips. We don't say it's a change of 1.2 pips. We only refer to the pip value. Likewise with the dollar Japanese currency pair, if this changes to 20, then that's an increase of 2 pips, or if it decreases to 1.5, then that is a decrease of 3 pips. So that in essence is how pips are shown in the Forex market. It just shows the change in price quote of a given currency pair. Moving on, then again, if the Euro USD changes from 1.0845 to 1.0846 like this, then it's a change of 1 pip. And if the dollar Japanese changes from 107.18 to 107.25, then it's a change of 7 pips. So that is pips in a nutshell, and just remember it's a unit of measurement showcasing the smallest change in price for any given currency pair. Moving on to our next popular Forex terminology term, it's called a spread. Now, a spread is the price difference between the buy or the ask price and the sell or the bid price, represented as a pip value. And when you open your MetaTrader 4 trading platform that we'll discuss later in this course, you will see something like this. And this shows you the sell price or the bid price and the buy or ask price of the given currency pair. Or you will see something like this. This is the Euro USD on a 30-minute time frame, where you will be shown the buy or the ask price here in red, or the sell or the bid price here in blue. So, and the difference between the ask and the bid price is then your spread, and that would be equal to 7 pips. So this difference over here is then your spread. So when you place a buy trade and you expect the market to go higher, you enter the market at this ask price over here, the red price of 1.1259, and you expect the market to go higher. So when you close your trade or you sell your buy trade, you exit at the bid price or the sell price. So let's just visually show you guys this. So if price moves upwards, then the new bid price becomes that, and the new ask price or buy price becomes that. So you bought it over here at the ask price of 1.1259, and you sold it here at the bid price of 1.1274. So that is how it works when you enter a buy trade, and that is a increase of 15 pips between this ask price and the bid price that you sold it. Likewise, when you place a sell trade, you enter the market at the bid price, and when you close it or you buy that trade, you exit at the ask price. So if we continue lower, you put a sell entry at the bid price of 1.12523, and then when the price moves lower, the new bid price then becomes 1.12215, and the new ask price or buy price then becomes something like this. So you sold it at the bid price over here, and you are going to buy it again at the ask price of 1.1229 over here. So that is then a decrease of, that's 30, 20, 23 pips. So you made 23 pips then on this trade. And the spreads are how most brokers make their money. And usually the bigger spreads there is, the more money the brokers made. So ideally you would like spreads to be as low as possible. Between 1 to 3 pips would be ideal to trade with. 7 pips is a bit big, and because that affects how much profit you make in the market as well. So hopefully that clears it up a bit, how the spread works, and that is our spread terminology. The next term we're going to look at is a lot, and Forex is traded in units of currency, otherwise known as lots, with one standard lot being equal to 100,000 units of the base currency in a currency pair. For example, if you buy one standard lot of Euro USD, and remember the Euro is the base currency of the currency pair, and the USD is the quote currency of the currency pair. Then when you buy one standard lot of Euro USD, you are buying 100,000 units or euros of the base currency, which is the euro, and you are paying with US dollars. So you are buying the base currency and you are paying with the quote currency. And the different lot sizes in Forex that you get is the standard lot, mini lot, micro and nano, with the standard lot being the most widely used by brokers and being equal to 100,000 units of the base currency. So for example, one lot would then be equal to 100,000, and then similarly 0.5 lots would be equal to 50,000 units or 50,000 euros in this example. So that in essence is how lots work in the Forex market, and that is how you trade the Forex market, by entering different lot sizes. Moving on to leverage. If you take this example, you buy one standard lot of Euro USD at this particular quote of 1.085, and you sell it later on when the market has increased at 1.09, then you will have a profit of $500. This is an increase of 50 pips, and the profit is determined by taking the difference in the pips times your lot size and times the dollar value per pip gives you your profit. And in the next lecture I'm going to dive deeper into how this works, and I'm going to give you guys some examples so you don't have to worry about how this works right now. Just know that with this particular trade, trading one standard lot, you would have received $500 profit. This shown in a different way, in a more linear way. By buying one standard lot of Euro USD, you buy 100,000 euros and you pay it with the quote currency or the dollar, and you pay $108,500 equal to this quote for the one lot of Euro USD. and then later on when you sell the same currency pair, you sell your 100,000 euros that you bought for 109,000 US dollars, meaning a profit of $500, similarly to this equation. So when you make use of without a leverage, you would need the full amount of 108,500 in your trading account to only buy one standard lot or 100,000 euros, and that is a big amount of money for retail traders to have. And just by looking at these values, that would discourage a lot of traders to start trading the forex markets. But with a profit of $500 on this $108,500 account, you would only see a 0.46% growth on your account, and that is nothing. And that is where leverage comes in the forex market, because with a leverage of 1 to 100, you only need a margin or a deposit of $1,085. So it's this number divided by your leverage. So that's 1% of the position size that you only need to trade one standard lot, resulting in a much better return on investment of the $500 profit over your required margin, leaving a 46% return on investment. So that's almost half of your trading account in this one trade. So that is what makes leverage so attractive in the forex market. Leverage allows you to trade large amounts of currency with little of your own money down, as long as you have the margin, this margin amount, to cover your trade. So leverage can be very powerful to use in the forex market. Moving on to our last popular forex term is margin. Margin is the minimum amount of capital you require to open a trade. And with a 1 to 100 leverage, you can trade a $100,000 account with only a $1,000 margin or deposit required. So here's a table of the different leverages you can find in forex. A 1 to 20 leverage require a 5% margin, with a 1 to 50 a 2%, 1 to 100 only a 1% margin required, like this example above. But I would advise you guys to stick to one of these two leverages when you start out with trading, because if you are still inexperienced, then leverage can be a very hard concept to grasp, and it can do more damage than good in the long run. So hopefully you guys learned some new forex terminology from this video, and after this video I'm confident that you guys can talk and use the same terminology in conversations, and you can impress your family and your friends with these cool terms and how to apply them in the forex market. Thanks for watching, and I will see you guys in lecture 4. Bye bye. In lecture 4 I'm going to show you guys exactly how you can calculate your profit or loss for a specific trade you are in, and we will be making use of this extremely straightforward equation below, with the profit or loss being equal to the total pips of your trade times the specific lot size you entered times the dollar value per pip. And the dollar value per pip just represents the change in dollars for every pip movement of a specific currency pair. And to determine the dollar value per pip, we are going to be using this My FX Book website, and we are going to be using the specific pip calculator tool to determine the dollar value for any given currency pair that you guys would like to trade. So this is the My FX Book website. For the account currency, we are going to be sticking to the dollar. For trade size, you just enter 1 for one standard lot. You press calculate, and then over here you guys can see the different currency pairs and the different dollar values for each currency pair using as one standard lot. So for example, the Australian dollar Japanese yen currency has a dollar value per pip of 9.487 at the time of recording. And just something quick that I want to mention to you guys, all of the currency pairs where the dollar is the quote currency has a dollar value per pip of $10. And here's the first example, the Australian dollar, American dollar has a standard lot is $10 per pip. To show you guys another example, here is the Euro USD is also $10, and the Pound USD is also $10. So wherever the US dollar is the quote currency, it will have a dollar value per pip of $10. So that is just something to remember. Now, going back to this equation, I decided to show you guys two really simple examples of how I calculated my specific profit and loss. And the first is we are going to buy one standard lot of Euro USD, and this is the chart. We're going to buy it over here at 1.0845, and we are going to sell or trade at 1.0865. So the difference between these two quotes is 20 pips, 20 pip difference, and that would be equal to your total pips in the equation. And your lot size would be the one standard lot. This is the pip difference. And then, as I said, when we visited the My FX Book website, the dollar value per pip for the Euro USD is equal to $10 per pip. That means that in this specific trade you would have made a profit of $200. So that is one example. And just another example, we are going to sell 0.5 standard lots or 50,000 units of the dollar JPY at 108.65, and we're going to buy it at 108.50, meaning a total pip difference of 15 pips times your lot size of 0.5. And to determine the dollar value per pip, we are going to go back to this website over here, and we are going to determine the dollar value per pip for a trade size of 0.5 standard lots. Calculate, just scrolling to the dollar Japanese yen, it's over here. It has a dollar value per pip at time of recording of $9.49. So just going back to this equation, $9.49 per pip leaves you with a profit of $71.18. So that is how you guys can use this equation, and it's a really simple tool that you guys can use if you are curious about how much profit or loss you are potentially going to make with a specific trade, and hopefully that will help you guys in the future. I will see you guys in the next video. In lecture 5, we will be taking a look at the different types of Forex traders you'll find in the Forex markets. And depending on your personality as a trader, your risk appetite and your level of comfortability with staying in the market, it will determine which type of Forex trader you become. Now, the first type of Forex trader in the market are called scalpers. Now, these traders like to be in and out as quickly as they can in the markets, and therefore their trade duration tend to be only a few minutes, with the two time frames that they focus on being the minute 1 and the minute 5 time frames, and their target per trade being 5 to 10 pips. These scalpers don't like to be in the market any longer than they absolutely have to, and they are comfortable by taking smaller trades and lots more throughout the day than any other trader. Now, the second group of Forex trader you'll find in the Forex markets are called day traders. These traders tend to have a trade duration of a few hours and mainly focuses on the minute 15, minute 30, hour 1 and hour 4 time frames, and they tend to target a higher pip range than scalpers of 15 to 40 pips. And day traders like to enter and exit a trade on the same day, and they don't like, also like scalpers, they prefer to be in and out of the market as quickly as they can. Now, the third group of Forex traders you'll find is swing traders, and they tend to have a trade duration of a few days to a week at most, and mainly focuses on the time frames of the hour 4 and the daily time frame, and they tend to target a 50 to 150 pip range per trade. Now, swing traders are more comfortable with staying in trades for a number of days to a week or two, and they tend to look at the bigger picture, the bigger time frames, the overall market direction in the long term. And for me, personally, I'm a swing trader. I like staying in the market as long as possible, or as long as it takes for my specific trade setup to work out. And then this leads us to the fourth and the final type of Forex trader, called the position trader. The position traders tend to have a trade duration of a few weeks to a few months, and they focus on the daily, the weekly and the monthly time frames, and they target a massive pip range of 200 to 500 pips per trade. So these traders are very comfortable with staying in trades for weeks to months on end, and they also like to look at the bigger picture, the overall market direction, where scalpers don't really focus on the big picture but only trade the small gyrations in the market on a daily basis. So dependent on your personality as a trader, your risk appetite, your level of comfort, you'll find yourself in any of these four groups of traders. So we'll dive into how your trading personality affects the type of Forex trader you are in a later video in this course. But this was just to give you guys an indication of the four groups of Forex traders that you'll find in the Forex markets. Thanks, and I'll see you guys in lesson 2. In lesson 2 of the complete Forex trading guide for beginners course, I'm going to show you guys exactly how to master technical analysis. And to start, I'm going to discuss the importance of technical analysis for Forex traders. Now, technical analysis is a study of price movement that entails looking at past price trends and patterns in the market to discover how it can affect current price movement. So in essence, you are looking at the past and you are analyzing the past and you are basing your predictions of the past on the current and the near future price movements. So you are looking and you are analyzing different chart patterns and price trends of the past, and you are looking where you can apply them in the current market conditions. So in a nutshell, that is technical analysis. Now, technical analysis is used to determine with relative degree of confidence a directional bias for price to move to in the near future. Like I said, you look and analyze past price movements to determine whether the current price is likely to go up or down, and that is what technical analysis is used for by forex traders. Now, the study of historical price movements are used to create trading plans around the idea that current price action will likely follow similar movements in the future. And the old adage, history tends to repeat itself, is so important in forex trading, and it's so relevant here with technical analysis. Now, technical analysis is always performed on price charts, seeing as it's a visual representation of past price action, and it helps you to visualize how the past price action and patterns is likely to play out in the future. Now, technical analysis can be very subjective, meaning two people can interpret the same thing entirely differently, meaning two people can watch the exact same past data and have completely different opinions about the future price movement. For example, one can think that the price is likely to increase and another can think that the price is likely to decrease in the near future. So it's therefore important to learn how to apply these technical skills correctly when you start trading. Now, and without technical analysis, you are essentially trading blind and just guessing, i.e. gambling. Without performing the required analysis, without doing the work, you are just basically guessing with a 50% chance of being accurate, where the price will go higher or lower in the near future, and that's not what forex trading is all about. So in the next lecture, I'm going to show you guys exactly how to read the candlesticks to apply technical analysis to. Thanks, and I'll see you guys in the next video. In lecture 7, we are going to be taking a look at how to read and interpret the different candlesticks in the market. Now, candlesticks are an indication of price movement for a given time frame, and this time frame can be in minutes, days, weeks, and even months. And each candlestick is made up of an OHLC level, or an open, a high, a low, and a close level. So each candlestick contains its own unique 4 levels of price. As you can see, for this specific green candlestick, it has a high level, meaning it's the highest that price has gone for this specific candlestick. A close price at over here where the candlestick closed and a new one opened, and then where this specific candlestick opened, meaning the previous one closed over here, and then a low level, the lowest that this candlestick has been. So these are the 4 levels, the OHLC levels, that each and every one of the candlesticks in the forex market contain. Now, you will see when you open your forex charts that the forex charts usually contain green and red candlesticks. Now, the green candlesticks, or the bullish candlesticks, means that price has increased. So let's say, for example, this candlestick opened at 1.0500. It reached a low point of 1.0480 and a closing point of 1.0520 and then high of 1.0540. So you can see between the opening and the close of the candlestick, it was an increase of 20 pips. So therefore it's a bullish candle, or a visually shown as a green candlestick, and vice versa for the red candlesticks or the bearish candlesticks. You have your open at the top and it's a lower move with your close at the bottom, and your low and your high stays exactly the same. So let's, for the same example, let's just say again your opening price was 1.0520. Let's just say it opened right after the closure of this candlestick. So where this candlestick closed, this one opened up over here with a high, let's keep it the same, of 1.054, a close of 1.05, and the low of 1.048. So between the opening and the closing of this candlestick, there was a decrease of 20 pips, meaning the price decreased, and therefore it's a bearish candlestick. And this is the essence of all candlesticks. It contains a high point, an opening level, a closing level, and a low level on the candlestick. So where the candlestick closes over here, the following candlestick opens up. So let's say this candlestick over here closed at this level, so the next one would automatically open up over here, and then it can either be another bullish candle or it can be a bearish candlestick. So, and that will be determined at the closure of the specific candlestick. So if the closure is lower than the open of here, open and close, then it will be a bearish candlestick or red candlestick. But if it closes above over here, then it's going to be an increase or a bullish candlestick. So that is the different candlesticks that you'll find in the Forex market. Now there are two types of candlesticks, like I said, a bullish or a price increase and a bearish or price decrease candlesticks, and these are usually shown as green or red candlesticks. Now I'm going to show you guys some live examples of candlesticks on the MetaTrader 4 trading platform. So this is the MetaTrader 4 trading platform that I'll show you guys later on in this course, and these are all of the candlesticks that we talked about. Now each candlestick is for a certain time period, and the time periods you can choose above here. So this is a minute 1 time frame, meaning that each one of these candlesticks is a 1 minute. So after a 1 minute, then let's say after this one has closed, then after a minute the next one will open. So this is 1 minute candlesticks, and then you also have your 5 minute candlesticks, meaning each candlestick is a 5 minute time period, your minute 15, 30, your hour 1, so each is 1 hour, hour 4, so each candlestick is a 4 hour time frame. Then you have your daily, weekly, and your monthly candlesticks. So these are all the different time frames that you'll be using throughout your technical analysis, and we'll get into some more detail later on in this course. But just to show you guys, again, this is a minute 5 time frame, and as you can see, let's say this bearish candlestick over here, it made a high of about 70.085. Let me just move this. It opened up at this level, let's just say it's around 70.03. It closed at this level, 70.01, and it made an all-time low of, let's just say, 69.98. So these are your 4 levels that each and every candlestick on here has, and we'll get into how you can analyze and interpret these different candlesticks later, but just know that price is continuously changing, and there's continuously a battle between the bulls and the bears. The bulls are the green candles, and they want price to increase, and then the bears, the red candles, they want a decrease in price. So these candlesticks are in a constant battle to push the price either higher or lower, and you can start to interpret the different candlesticks in a manner to determine where price is likely to go to in the near future, just by reading each candlestick or a group of candlesticks on their own. And each candlestick tells its own unique story and its own unique battle between the bulls and the bears. For example, this candlestick over here, you can see that after the closure of this candlestick over here, the bulls took control and they pushed price higher to this point, but as soon as it touched this point, the bears came back in control and they ultimately pushed the price lower than the previous open, and it closed lower than this candlestick. So in this example, the bears won, and just like this candlestick, every candlestick has its own story, and with some experience and training, you learn to read and interpret each candlestick individually. So that is how you guys can analyze the candlesticks, and hopefully that gave you guys a broader understanding of candlesticks in the Forex market. And I'll see you guys in the next video. Bye bye. In this lecture, I'm going to show you guys exactly how to identify market direction for any currency pair that you are busy trading. Now, there are 3 types of trends that you'll find in the Forex market, namely an uptrend, something like this, a downtrend moving lower, and a sideways or a consolidating market that's just moving sideways. Now, there are 2 ways to determine the specific market direction, and the first is by looking whether the market is making higher highs and higher lows for uptrends, or making lower highs and lower lows for downtrends. What I mean by this, for uptrends, this example over here, this over here is called a swing high, and this is called a swing low, and this is also a swing high and a swing low, meaning that this move over here has a high point of there and a low point over there. So by using this analogy of the market making higher highs, higher highs, higher highs, higher highs and higher lows, higher lows, higher lows and higher lows, you can see that the market is on a clear uptrend, and it's bouncing from high to low, and each time it's going higher and higher and higher. And for downtrends, by following the vice versa of uptrends, where the market makes lower highs and lower lows, you can see here's a high for this specific pair. It's making a lower high, lower high, lower high, and then a lower low, lower low, lower low, and lower low. So it's bouncing from the lows to the highs, and that is on a clear downward path. So just think of uptrends as going up the stairs. With each step you go higher and higher, and downtrends coming down the stairs. With each step you are going lower and lower. So that is the first way to determine the market direction, and the second way is using moving averages. Now moving averages are just smoothed out representations of the market. So instead of seeing this, we visually represent this move as a smoothed out line or moving average like this. This is called the 50 moving average, and over here it's a smoothed out representation of this move as well. And here's another one, 100 moving average, and the 100 moving average, and the 200 and the 200. So as you can see, all of these moving averages get smoother and smoother the larger they become. Now, how you can determine the trend direction for uptrends is when the 50 moving average is above the 100 moving average and is above the 200 moving average. So it's the 50 is at the top, and it's just getting bigger and bigger the lower you go. So that's a clear uptrend. And then for downtrends, the 50 is the lowest, then the 100 is higher, and the 200 is the highest. So yeah, the 200 is at top, then the 100, and then the 50. So as you can see, all of these moving averages are just going lower and lower, and for uptrends they are just going higher and higher. So these are the two ways that you can determine the market direction, and I'm just going to jump into the live markets, and I'm going to show you guys how to determine market direction with live charts. So over here we have the Euro USD chart. It's on a 1 hour time frame, and as you can see, it's on a clear uptrend. And by making use of the two methods that we mentioned, taking this high, we see that it made a higher high, a higher high, and a higher high. With this low, it made a higher low, and a higher low. So market is just going up the stairs, and it's bouncing from low to high. Clear uptrend, together with the 3 or 4 moving averages all going higher. These are two clear indications that we are on a very strong uptrend. So when you see this in the market, then this would be good opportunities to look for buy entries. So places like this, where you want to buy the Euro USD for price to increase to over here, and then sell it over here for some profit. Now this is an example of an uptrend. If we go to the US dollar, Canadian dollar, and making use of the same two methods as mentioned previously for downtrends, we can see by using this high, it made a lower high and a lower high. Using this low, it made a lower low and a lower low, lower low. So market is just going down the stairs and is on a clear downward move. And you can see as well with all of these moving averages just going lower and lower. So this is again also a really strong downtrend. So you will be looking for entries to sell this market. So maybe over here, sell it to over here, take profit, and then you will be happy. Now I'll just show you guys a quick example of a consolidating market, what that looks like. Also on the US dollar Canadian pair, and as you can see, this is what the consolidating market looked like. There's just no clear indication where market is going, and it's just bouncing up and down and up and down, and it's not making a higher high or a higher low. This is basically the same highs and these are basically the same lows, as well as the moving averages all are just overlapping like this, overlapping. So this is a sideways market or a consolidating market, and if you have some experience with consolidating markets, then you can enter trades at the top and you can take the trade to the bottom or the support area, but we'll get into some more detail later on in this course. So that is market directions, and that is how you can identify them using the two ways that I showed you guys. So thanks for watching, and I see you guys in the next video. In this video I'm going to show you guys how to draw trend lines correctly in the Forex market. Now, if you can remember from the previous video where we discussed how to determine market direction, there were two main methods that you could use to determine market direction. For uptrends, it was to determine whether the market is making a higher high and a higher low, and for downtrends, whether the market was making a lower high and a lower low. And the second method was a visual representation of price or moving averages that gave you guys a smoothed out representation of price. Now, in today's video I'm going to show you guys another way to visually indicate the market direction, otherwise known as trend lines. And trend lines can be either uptrends or downtrends, with uptrend showing a bullish market or an increase in price, and the downtrend showing a bearish market or a decrease in price. Now, as you can see, for uptrend, the market is making higher highs and it's making higher lows, as well as on a downtrend, the market is making lower highs and lower lows. Now, how you go about drawing these trend lines is, for uptrends, you draw a trend line along the bottom of at least two valleys. For example, you connect at least two of these valleys of this movement, and you draw a straight line connecting these two valleys of this movement. And then for a downtrend, you draw a trend line along the top of at least two peaks. So you see the two peaks in this movement, and you draw a trend line connecting the two peaks, and you see a third over here as well. Now, trend lines should have at least two touches to it, with a third touch that acts as a confirmation. And the more touches that a trend line has, the stronger and the more reliable the trend line becomes in the market. Now I'm going to jump into some live examples of how to draw an uptrend and a downtrend in the market. Okay, so here we have a live market of the US dollar, Swiss franc, as you can see in the left corner over here, the US dollar Swiss franc. And this is a trading platform called TradingView, and I'm going to do a more comprehensive video about TradingView and how you guys can use TradingView in a later video. But for now, I'm going to show you guys just how you can draw the different trend lines on this chart. Now, as you can see with this chart, you probably noticed that this over here is an uptrend because the market is making higher highs and higher lows. So that is a clear indication of an uptrend, as well as you can see the moving averages, this black and blue line, are all going upwards. So those are two indications that we are on an uptrend. Now, like I said, how you draw a trend line for uptrends is you connect at least two of the valleys of the move like this. As you can see, I connected this valley and this valley over here, and we have a third touch over here and the fourth and fifth touch over here as well. Now, these would have been some good areas where you could have enter some trades over here to possibly take a long position for price to go higher at the third touch or the third confirmation of the trend line. And as you'll see later on in this course, trend lines are really reliable technical tools that you can use in the Forex market. Now, like I said, you draw the two valleys and a third and a fourth valley, just show you guys that this is a really strong and reliable trend line in the market. Now, I'm going to show you guys on this British pound Swiss franc trade how you can draw down a downward trend line, and just like with the upward trend line, you're going to connect two of the peaks over here like this. You connect the two peaks, this being the first peak and the second peak, the third just acting as a confirmation, and you could have entered a short position over here to catch this downward move. And like I said, these are some really reliable technical tools that you'll find everywhere in the Forex market, and it's a really good tool to add to your trading toolkit. So that sums up trend lines, and in the next video I'm going to show you guys how to draw channels. Thanks. Being able to draw channels as a Forex trader is another important technical analysis tool to have in your trading toolkit, and channels are so easy to draw. You just make use of trend lines, the trend lines that you learned in the previous video. As you can see, this is an upward trend line, and we connected the two valleys with the third being a confirmation, and this is a downward trend line or a bearish trend line, and we connected the two peaks and a third peak acting as a confirmation. Now, drawing the two channels, the bullish channel and the bearish channel, is so easy to do. For bullish channels, all you have to do is you draw a trend line parallel to the upward trend line, connecting at least two of the peaks like this. This trend line is exactly parallel to this upward trend line, and you connect at least two peaks. So as you can see, this is a bullish channel where the price is just bouncing in between this channel and it's moving higher, and vice versa. For bearish channels, you just draw a trend line parallel to the downward trend line, connecting at least two valleys like that, and this trend line is connecting at least two valleys, and price is just bouncing in this bearish channel and it's moving lower. So that is how you draw channels, guys. It's really straightforward, and I'm just going to show you guys some live examples again. So this is the upward trend line I drew in the previous video. Now we're going to use this trend line to draw a bullish channel, and I'm just going to click on this trend line, and you're going to make a clone of it or a copy, and you're going to connect at least two of the peaks of the top of the move like this. And as you can see, you just connect at least two of these peaks, and don't worry that they aren't so perfectly drawn. This is more of an area of upward trend line area, and it's important just to connect as many of these peaks as possible. You could draw your channel a bit like this upward. Also, there's no 100% correct way to do it, but I just like to connect as many of these peaks as I can, and this is just to visually give me an indication that price is ranging inside of this bullish channel. Then for our bearish channels, this is a different example, and like I said, you can see this is a clear downward trend by looking at the price making lower highs, lower highs, lower highs, and lower lows. So price is moving lower, as well as by looking at the moving averages. You can see it is a clear downward move, and we start by drawing the downward trend line by connecting at least two of these peaks in this movement, like I'm doing over here. As you can see, this is the first peak, second peak, and the third touch, fourth touch, fifth touch, just acting as confirmation. Now to draw a bearish channel, I'm also just gonna make a copy of this trend line over here, and you're gonna connect it to at least two of the valleys below, like this, at least two touches. So it's a touching here, there. So this is also a really good bearish channel. The price is just bouncing up and down, and it's making a move lower. So that is channels, guys. Really straightforward to do, really powerful technical analysis tool to have in your toolkit, and it just gives you guys an extra visual aspect to your trading. So this is a bearish channel and this is a bullish channel, and they appear so frequently in the market, and I hope you guys will be able to draw them when you spot them in the market. And I'll see you guys in the next video. Thanks. Knowing how to place support and resistance areas correctly in the market is a really important technical analysis tool for any forex trader to have. And in this video, I'm going to show you guys exactly how I go about drawing my support and resistance areas in the forex markets. Now, support and resistance areas indicate a given price range that the market is struggling to break past, and where there is likely to be some sort of price movement. Now, to give you guys an example of how support and resistance areas work, is to think about any room inside of your house, with the floor of the room being the support area and the roof in the room being the resistance area. Now, by going inside of the room and taking a bouncy ball and throwing it as hard as you can against the floor area, you will see that the bouncy ball immediately heads towards the roof of the room or the resistance, and at the roof it tends to have a reaction. It struggles to break past the roof, and it heads back down towards the floor of the room. Similarly, at the floor or the support area of the room, there's a reaction again. It struggles to break past the floor area, and it heads back towards the roof or the resistance, and it continues this cycle for a couple of times. And it's important to note that support is always found below the current market price, and resistance is found above the current market price. So for example, let's say we are over here in the market, support is always found below the current price and resistance is found above the current price. And also it's important to remember that this consolidation isn't going to go on forever. Price isn't always going to react at either the resistance or the support areas in the market. And when the support is broken, it becomes a resistance area. So for example, if price decides to break past this current support area, it becomes a new resistance area because it is now found above the current market price. Like we said here, resistance is always found above the current market price. Likewise, when the price decides to break through the current resistance area, the resistance area turns into a support area because the support is now found below the current market price. So it's important to know that price doesn't always continue in this consolidating cycle, and it tends to break out of either the support or the resistance levels. Now, to draw your support and resistance levels, there's a certain process that you need to follow to successfully place your support and resistance areas in the market. Now, the first step is to select a daily candlestick where each candlestick is equal to a 1-day time period, and to select a 1-year time period on your charts. And you can do this by making use of a trading platform called TradingView, like I showed you guys in the previous video. And another step, or second step, to drawing the support and resistance areas is to identify the yearly highs and lows on the chart that you're looking at. So any chart, whether it's the USD, pound yen, Australian dollar, Canadian dollar, any chart, is to identify the yearly highs and lows and to place a support and resistance area at each level. And the third step is to place areas where there are at least 2 bounces at the same price region. So how you go about it, it's, let's say over here this price is equal to 1.1 and this price is equal to 1, and you see that price tested the 1.1 region and it rejected the area and it made a bounce lower, and later on it bounced again at this price level. And by taking these 2 bounces, you connect them, you draw a line, and you see that later on as well there was a third bounce at the 1.1 price range, and this becomes your resistance area. Likewise for support, you see that the price bounced at the 1 mark, the 1 price level, and again it bounced and reacted and continued higher, and so you connect your 2 bounces at the 1 price range, and you see later on there was a third bounce and a third touch as well. So that is the process of how you draw your support areas, and I'm going to show you guys exactly how to do this in the live markets later in this video. Now, there are certain rules to follow when you draw your support and resistance areas in the forex markets, and the first is to place the areas on candlestick closures or the candle body closure. And as you remember from a previous video, each candlestick is made up of a open, a high, a close and a low level, and this will be a green candle or a bullish candle, and it's important to place your area at the closure of this candle over here, because that is where price closed, and that is where the big financial institutions, the retail traders, decided to push the price to and to close the price. So I'm going to show you guys how to do this in the video. So that's the first rule. Now the second rule is the more recent the bounce, the better. So to focus on the recent price bounces, and that is why I said we are only going to stick to a 1 year time period in the market, only a 1 year time period. You don't want to go too far back in time. You don't want to draw support and resistance areas from 6 or 10 years ago, because that's most likely not going to be very relevant in today's market. So I would say 1 year works very well to place your support and resistance areas, with a bit more focus being placed on the recent bounces within a month or two. But I'll show you guys later on at the live markets. Now the third rule is to only use a maximum of 6 to 8 support and resistance areas when you are drawing them on your charts. You don't want to over clutter your charts and make it too messy, and you want to be able to read the price action as well. So 6 to 8 support areas works perfectly. And the last rule of support and resistance areas is that the more bounces there is, the stronger the support and resistance area becomes. As you can see here, there's 3 bounces, so this is a really strong resistance area, and you're likely to expect price to have a reaction at this area. And this is also a really strong support area because there's 2-3 bounces at this area. So like I said, the more bounces, the stronger the support and resistance areas become. Now I'm going to jump into some live market examples, and I'm going to show you guys exactly how to go about drawing your support and resistance areas. Here we have the Euro USD chart on TradingView, and as you can see, we are on a 1 hour time frame, and like I said, in the process you need to select a 1 day candlestick, and together with a 1 year time period at the bottom over here, and that is how you start your process to draw your support and resistance areas. Now the second rule becomes to identify the yearly highs and lows in the market, and as you can see, in this 1 year time period, this is the swing low, and this more recently is the swing high, the highest point in this 1 year time period, and this is the lowest point in this 1 year time period. So you identify these areas and you place a support and resistance area at each of these levels. Now to draw your support and resistance areas, I like to use the parallel channel tool at the left toolbar on TradingView. You just select parallel channel and you just make a area like this, and you can edit this, you can make it any color you like, you can play around with it. I like the blue and the black combination. So like I said, you place your area at the yearly high, and I'm going to make a copy of this, and you place it at the yearly low. And a rule that I also said is to place the areas at the candlestick closures. So I use this black line over here and I place it over there at the candlestick closure, just to be a bit more accurate, as well as at top of this resistance. You can see it's just at the candlestick closure over there. So again, I select the 1 year period, and that is the first thing that you do. You select your daily candlestick, 1 year time period, you identify your yearly highs, your yearly lows, and you place an area at each level. Now another thing is to determine where price bounced at a specific level at least 2 times, and a good area in the market would also be this area over here. And I'm just gonna zoom in a bit and place my support and resistance area at that candlestick closure over there, because it's a bit more recent. So zooming out to 1 year time period, you can see that price tested this level. It's a resistance and continued lower. It almost came back and tested it again. Over here it had a reaction and it continued lower. As I said here, price broke past the resistance and it became a support area now, and more recently over here the price bounced off the support area higher. So that is our first that is our third support and resistance area in the market. Another one would be over here at these levels. I'm gonna emphasize more focus on the recent touches. So I'm gonna put my area at this candle closure over here, and again 1 year time period. You can see that in the past it reacted over here and again over there and there, another bounce over there, and it became a resistance area for this move. Resistance, so this was a resistance area, it broke past, so it became a support area, and that is the essence of support and resistance area. The move, it doesn't always continue like this. It eventually breaks either through the resistance or through the support area. Now another important area that I would use is this one over here, and let me just put it over that candlestick closure. As you can see, price bounced over here at the support and then again more recently over here, and just selecting the 1 year time period once more, we can also pick this high over here where price bounced and reacted at these levels over here. It reacted over there, and then more recently over here. So I would say this is sufficient. We have our 6 support and resistance areas, and now we can watch out for how price reacts at these levels. For instance, let's say that the price comes down to the support area. We know that it's likely to have some sort of reaction at this area, and that is what I'm going to teach you guys later on in this course, is how to trade these support and resistance areas, how to make money off of them, and how to identify in which direction the price is most likely to move in. So that concludes this video on support and resistance areas, and I'll see you guys in the next video. Thanks. Let's take a look at some of the most important chart patterns to know as a Forex trader when you are performing your technical analysis on a specific chart. Now, chart patterns helps you identify specific areas where price is likely to break out of and continue moving in the same trend direction, or can act as key trend reversal indicators. Now, what I mean by this is, let's take for example an uptrend move like this, and at this specific price level on the chart there is a formation of a specific chart pattern. Now the chart pattern in question can either give you an indication that price is likely to continue higher or in the same direction as it entered, or it can give you an indication of a possible trend reversal. So in this example, for price to continue moving lower. And there are loads of different chart patterns that you'll find and can analyze in the market, and depending on the specific chart pattern and where it's located in the market, it can give you either an indication that price is likely to continue in the same trend direction, or a trend reversal is likely to happen in the near future. Now, when the market breaks out of these patterns, it usually leads to an aggressive price move. giving the example of the uptrend again. Here is the formation of the specific chart pattern. Now in the specific chart pattern there is a consolidation and a build up of price momentum, and price can't consolidate forever in this box, and eventually it has to break out either to the top or in the same direction as the preceding direction, or it can act as a trend reversal and continue lower. And these moves are usually very aggressive, and there's a lot of volume in these moves due to the build up of momentum and the escape of momentum when the specific chart pattern gets broken in the market. Now there are loads of different chart patterns, but I'm going to show you guys some of the most common patterns to keep an eye out for in the market, and how to analyze and trade these specific chart patterns when they appear in the market. Now the first chart pattern, and probably one of the most common chart patterns, is called a double top or a double bottom. Now say for example price is moving higher and it reaches a certain price point and it makes a correction lower, turns around higher, reaches the same point over here, and then acts as a reversal. Now in the previous video we said this then becomes a resistance zone, or in this case it is a double top chart pattern. It touches the same price twice, meaning it makes a double top, and a double top is usually a trend reversal indicator. So with a preceding uptrend, when a double top appears, you can likely expect a change in trend and a move lower. Likewise for double bottoms, with a lower move like this, price can reach a certain point, make a correction, come back to the same point and continue higher. And this would be a support area, and as you see it touches a certain price twice and it makes a double bottom chart pattern. So these are the double top and this is a double bottom chart pattern to look out for when you are trading. Now another common chart pattern is the head and shoulders chart pattern, and example over here is this. This is the shoulder, this is the head of the move, and this is the shoulder. So over here is your neckline, and this being your left shoulder, your head, and your right shoulder. And on the flip side, vice versa, you can also get an inverse head and shoulder where it looks like this, with the shoulder, the head, and the right shoulder over here with the neckline over there. So this is the left shoulder, the head, and the right shoulder. And these two specific chart patterns are usually trend reversal or trend continuation patterns, meaning that price can enter over here, the formation of this chart pattern can happen and price can reverse, or price can enter over here, the formation of the pattern can happen and price can reverse from there. So these are also very common chart patterns to be aware of. Now another one is a triangle chart pattern that I'll show you guys in the live example of this video. Then you also get rising and falling wedges, and here's an example of how a wedge looks. As you see, price is consolidating between a upward moving support trend line and an upward moving resistance trend line. So price is consolidating between these two pairs, and as you can see there's also a build up of momentum, and price usually follows an aggressive move to the downside. So Wedges are key trend reversal indicators and can also act as trend continuation patterns wherever they appear in the market. And then a last chart pattern to be aware of is a flag pattern, and you get two flag patterns, namely a bullish and a bearish flag pattern. This over here is called a bullish flag pattern, and this trend line over here is the flagpole of the flag pattern, and this consolidating area is called the flag. So you expect a continuation move when you see this chart pattern in the market. Likewise for bearish chart patterns with a downward movement, the downward flagpole, you expect some sort of consolidation and then a continuation in the same preceding trend. So I'm going to jump into some live examples, and I'm going to show you guys exactly how to draw and analyze these specific chart patterns when they appear in the markets. So this is the US dollar Swiss franc chart on a 1 hour candlestick time frame, and I'm going to show you guys 5 examples of chart patterns, how to recognize them, how to analyze them, and most importantly how to trade them when they appear in the market. Now our first pattern over here is the double top that we discussed, and as you can see, price reaches a certain level over here. Let's say for example that level is 0.999, and then price makes a quick correction. It heads back to the same level, and as you can see, it forms a double top. And like I said, double tops are usually trend reversal indicators, so meaning when the preceding trend is upwards and the formation of a double top appears, then you can expect a move lower or a downtrend to take place after the formation of the double top. And how you go about trading a double top is you draw a support line over here and you wait for the second top to break this specific area, and you enter the trade over here and you catch this move lower to the downside. So that is how you can trade a double top. And when double bottoms appear, for example like this, the same rules apply. You wait for price to break above this specific resistance area over here and you catch the move higher. So that is how you can trade a double top and a double bottom when they appear in the market. Moving on to our next chart pattern. This is the head and shoulders chart pattern. As you can see, here's the formation of the head and shoulders. Now head and shoulders can act as either trend continuation or trend reversal indicator, and it's more common to act as trend reversal indicators. As you can see, the preceding move is upwards, then you get your creation of your left shoulder, your head over here, and your right shoulder. Now how you go about trading this head and shoulder is you draw your neckline over here and you wait for the right shoulder to break this support area and you continue the move lower. And for the inverse or inverse head and shoulders, the same rules apply, where you just draw your neckline over here and you wait for the right shoulder to break the resistance area and you continue the move higher. So keep an eye out for these chart patterns. They are very common, and just draw a support area or a resistance area and wait for the right shoulder. Always wait for the right shoulder to break the support or resistance area, and then you can enter the trade. So that is head and shoulders. Now another good chart pattern to be aware of is called the rising wedge, and a rising wedge also can act as a trend continuation or trend reversal pattern. And how you go about drawing these chart patterns is you connect a trend line from the first valley, and you connect as many of the valleys as possible, like we did when we discussed trend lines. And the upward trend line, you connect as many of the peaks as possible, like we also discussed in the trend line. And as you can see, price is just consolidating between both of these upward trend lines. And how you go about trading a rising wedge is you wait for price to break out of this pattern like this over here. You wait for it to break out and you catch the move to the downside. And like I said, depending on where the specific chart pattern appears in the market, it will either be a trend continuation pattern or trend reversal pattern. But as you can see, this was quite an aggressive move lower. After this build up of momentum, price just accelerated to the downside, and that is usually what happens when specific chart patterns break. So this is the fourth chart pattern that we are going to be looking at, the bullish flag. And like I said, how to trade a bullish flag. These flag patterns are usually trend continuation patterns, and the preceding trend is upwards. So this is the flagpole. Now price is consolidating over here in this bearish channel over here, the bearish channel, but it's a bullish flag because price goes in the same direction as the preceding trend when it breaks out of this flag pattern. And how you go about trading this flag pattern is you wait for the most recent resistance area in the consolidating channel to break like that, and this would be your entry point, and you would catch this move higher, and you usually target the same length as your flagpole once the price is broken out of this channel. Likewise for bearish channels, when the move is lower and you have some sort of price consolidation in this bullish channel but a bearish flag, you can expect the price to break lower to the downside, and you wait for price to exit the most recent support area over here, and you catch the trade lower. So that is bullish and bearish flags. And then our last chart pattern is called a triangle chart pattern. I'm just going to switch to a 4-hour time frame over here. As you can see, this is a triangle chart pattern. It contains a increasing trend line and an increasing trend line as support and a decreasing trend line as resistance, and price just consolidates in this triangle, and it gets smaller and smaller and smaller, and momentum build up occurs, and price can either break out of the top and continue higher, or it can break out of the bottom and continue lower. So also depending where price breaks out of, this triangle can act as a trend continuation pattern or trend reversal pattern. And in this case, price broke out of the bottom of the triangle and an aggressive move lower happened after the momentum build up. So that is just some of the important and most commonly used chart patterns to be aware of in the forex markets, and how to trade these specific patterns. So keep an eye out for each of these patterns. They are really reliable, and really they have a very high win rate to trade them. And when these chart patterns are broken, that would be your indication to enter the specific trade. So that concludes this video of the chart patterns, and I'll catch you guys in the next video. Thanks for watching. As a Forex trader, it is your job to correctly determine the direction that price is likely to head to in the near future. And to do just that, Forex traders make use of an array of different technical analysis tools, of which one of the most important technical tools is the ability to correctly analyze candlestick patterns. Now, in the market, there is a continuous battle going on between the bulls and the bears. The bulls being the buyers and the bears being the sellers, with the buyers trying to push the price as high as possible and the sellers trying to take the price as low as possible. And this continuous battle between the bulls and the bears is visually displayed through candlesticks. Now, as I mentioned in an earlier video, each candlestick tells its own unique story. Each candlestick has an opening price, closing price, low and high. And making use of an array of candlesticks or candlestick patterns in the market helps Forex traders to determine the most likely direction of price in the near future. And in this video, I'm going to show you guys some of the important candlestick patterns to consider in trading. Now, the first candlestick pattern to be aware of is the bullish engulfing pattern over here at the left. And this is formed when a bearish candlestick, this red candlestick, fully engulfs the previous candlestick. And this previous candlestick can be either a green or a red candlestick. It can be either a bearish or a bullish candlestick. The important thing is just that the second candlestick over here fully engulfs the first candlestick. As you can see, the high of this candlestick is higher than the previous candlestick, and the low is lower than the previous candlestick over here. So this red candlestick fully covers or engulfs the previous candlestick. And this, when this pattern appears in the market, it is likely that price will continue lower or decrease. And just like the bearish engulfing candle, there's also a bullish engulfing candle where the reverse is true, where the second candle, the bigger candle, is always the bullish candle, and the first candle can be either a red or green candle. The important thing is just that the green candle, the bullish candle, fully engulfs the first candle like that. And this candlestick pattern usually follows with an upward move like this. Another good candlestick pattern to look out for is a shooting star candlestick over here. And this candlestick tells a story of how the bulls try to increase price higher, and when it reached a certain point, the bears just took complete control and pushed the price lower, and the price closed over here much lower. And what you can expect from shooting star candlesticks are usually a move to the downside, a lower move, due to the shift between the bulls. Here the bulls were in control, and a shooting star is a shift of momentum from the bulls to the bears usually. And the same is true with a hammer candlestick pattern, where a hammer is also where the bears try to take control, but at the end of the candlestick the bulls won the battle and the candlestick closed over here. So a hammer is again a reversal of a change of hands between the bears and the bulls. So the hammer candlestick usually signals a move to the upside. Now another good and more recognizable candlestick pattern is the tweezer tops, and this is how the tweezer tops looks. They give both of their wicks are to the upside, meaning that the bulls tried to push price up not once but twice and failed on both occasions, and the momentum changed hands from bulls to bears. So this follows usually a move to the lower side. So after a bit of experience in the market, you'll start to recognize these candlestick patterns, and remember that each candlestick pattern and candlestick on its own tells its own unique story of where price is likely to head to in the near future. So let me just jump into some live examples and I'll show you guys how price reacted when certain candlestick patterns appeared in the market. So here are some examples of the candlestick patterns that I showed you on the previous slide, with the most obvious starting on the left, a shooting star pattern that formed over here. As you can see, the bulls tried to push the price higher, but at the end they failed to, and price made a move lower after the formation of this shooting star candle over here. The next candlestick pattern that formed was the hammer candlestick. I'm going to zoom in a bit so that you guys can see a bit more clearly, and the hammer candlestick is this candlestick over here. And as you can see, the bears tried to push the price lower, but at the end the bulls won this specific battle, and as you can see, price just continued higher and higher after the formation of the hammer. And just next to the hammer you'll also see a bullish engulfing candle over here. As you can see, this is the bullish engulfing candle, where the body of the second candle fully engulfs the previous candle. And it's just important to note where the bodies close. These wicks are of lesser importance. As you can see, it didn't fully engulf, but that's okay. The main thing to look out for is where the bodies of the second candlestick closes, and this fully engulfs the previous candle, and as you can see, a move higher takes place from there. So that is the bullish engulfing candle. Another candlestick pattern over here is the bearish engulfing candle that is formed over here. As you can see, the second candle fully engulfs the first candle over here, and a lower move follows after this bearish engulfing candle. As you can see, it's a shift in momentum from the bulls, and after this candlestick pattern appears, the bears have control in the market. Moving on to another candlestick pattern. This one over here is another bullish engulfing candle. It's a bit more clearer to see. Over here it just fully engulfs the previous candlestick, and this is a really aggressive candlestick, and you can expect a higher move to the upside. One more candlestick pattern to take note of is the hanging man candlestick, and it's just like a hammer, but it's usually instead, where a hammer is a continuation pattern higher, a hanging man signals a price reduction or a decrease in price over the next few candles. So those are some of the candlestick patterns that I wanted to show you guys in the market, and it is important to note to not only trade these candlesticks on their own when they appear in the market, because as you can see over here is a bullish engulfing candle, and what you could have expected was that price would have made the move higher, but it didn't. It continued lower. So it's important to not only trade the candlestick patterns on their own, but to trade them in conjunction with other technical analysis tools like support and resistance areas, or chart patterns like the triangle, the wedge, or the bullish flag. And just to give you guys an example of what I mean, over here is a really good support area in the market, and you can expect some reaction from price, and with this formation of the hammer candlestick and the bullish engulfing candlestick together with the support area over here, a move higher appeared not once but twice. So it's important to use these candlestick patterns in conjunction with other technical tools to get the most accurate trading entries as possible. So that concludes the candlestick patterns, and I'll see you guys in the next video. In this video we are going to be discussing Fibonacci levels in the Forex markets. Now, before we dive into Fibonacci levels and how to draw these levels on the Forex charts, I thought I'd share with you guys some background into Fibonacci. Now, Fibonacci isn't this type of pasta that you can buy. He was actually a really famous Italian mathematician back in the day that came up with a certain mathematical sequence of numbers, or Fibonacci numbers, that goes like this, where each number in the series is the sum of the previous two numbers. For example, starting with 0 and 1 in the series of numbers, the third number being 1 is then equal to the current number or the second number in the series plus the preceding number or the first number in the series. Just like the fourth number being equal to 2 in the series then becomes the second number 1 plus the third number also 1. And you can repeat this process until infinity. So it's just important to remember that each number in the series is the sum of the previous two numbers. Now, after the first few numbers in the series, a ratio of 0.618 was found when you divide any number in the sequence by the succeeding number. For example, when you divide 55 by 89, you get 0.618. Likewise, when you divide 21 by 34, you get the same ratio. And it was also found that after the first few numbers, the current number in the sequence is always 1.618 bigger than the preceding number. And for example, the 34 is 1.618 times bigger than 21, just as 55 is 1.618 times bigger than 34. And this 1.618 is also the inverse of the 0.618 ratio. Now, this 1.618 is known as the golden ratio of Fibonacci, and this golden ratio actually appears all throughout nature, and you can find this ratio in shells, in tree branches, and even in the human body. Now, we are going to translate these Fibonacci levels and the golden ratio into the Forex markets. And the aim of Fibonacci retracement levels is to find hidden support and resistance levels in the market that can act as buying or selling areas to enter a trade in the trending market direction. So when you draw your Fibonacci levels in the market, all of these different Fibonacci levels can act as either support or resistance levels for price to possibly react to, and then either continue in the trending market direction or make a market reversal. Now, these Fibonacci levels are best used in conjunction with other technical analysis tools like the support and resistance areas, trend lines, channels, or even chart and candlestick patterns. It just makes these levels a lot more reliable when you use them with other technical tools. And the Fibonacci levels are also used by Forex traders to determine where to place key stop, loss, and take profit areas in the market. And we'll get into what this means later on in this course. And these areas are there to potentially exit the trade before price starts to move against them. Now, the three most important Fibonacci levels used by Forex traders are the 38.2% level, the 50%, and the 61.8% levels. Now, how you go about drawing Fibonacci levels is you can either draw them on uptrends or on downtrends in the market. And for uptrends, you click and drag the Fibonacci tool from the swing low to the swing high of the move. And what I mean by the swing low is, if you take a look at 3 candlesticks, and I'm just going to visually draw them for you. 3 candlesticks, an array of candlesticks like this. The swing low of these 3 candlesticks is where the middle candlesticks make a lower low than the candlesticks to its left and the candlestick to its right. Remember I said that each candlestick has a low, a high, an open and a close. Likewise for swing high points in the market, it is where the middle candlestick high point is higher than, where this high level is higher than the candlestick to its left as well as the candlestick to its right. So this is the swing high and this is the swing low. Now in this example, the swing low candlestick is over here and its low point is lower than the candlestick to its left and the candlesticks to its right. So likewise the swing high can be found over here and its high point is higher than the candlestick to its left and the candlestick to its right. So just think of it as a peak and as a valley. So for uptrends, you click and drag a Fibonacci tool from the swing low up to the swing high, and you'll find that all of these different levels are automatically given to you guys on the chart. And starting from the swing low, you begin with 1 or 100%, and the swing high then becomes 0. And all of these Fibonacci levels can act as support areas for price to move to. Now the way that a market works is it has 2 different types of waves, and both for uptrends and for downtrends. And for uptrends, the impulse wave is the wave to the upside, and that's the aggressive wave that gives you guys an indication of the trend direction. Then after an impulse wave, there usually follows a retracement or corrective wave, and then another impulse wave. So the idea is to enter a buy trade if price starts to stall at one of the Fibonacci retracement levels, and then for price to continue moving higher. So the idea behind Fibonacci is for price to stall anywhere on this Fibonacci wave over here. And as you can see, price stalled over here at the 38.2% Fibonacci levels, and then price continued moving higher. So that concludes our uptrends then. Then for downtrends, you click and drag the Fibonacci tool from the swing high to the swing low, and the swing high can be found over here because the high point is higher than the one to the left and the one to the right. With the low swing high, after swing low over here, it is lower than the one to the left and the one to the right. So for downtrends, you drag it from the swing high to the swing low, and the different Fibonacci levels are automatically drawn. And where the 100% or 1 level is at the swing high, and you work all the way downwards to 0. So just like for uptrends, you also have your impulsive wave for downtrends, which is downward. Then you have your retracement or corrective wave, followed by another impulse wave. And the idea is to enter a sell trade if price starts to stall at one of the Fibonacci retracement levels, and then for price to continue moving lower. And as you can see, price started to stall at the 78.6% Fibonacci retracement level, and it continued moving lower. So that is the background behind Fibonacci levels, and I'm going to show you guys some live market examples of how to draw these Fibonacci levels for uptrends and downtrends. So here we have our live chart, and this is of the Euro USD on a 4-hour time frame, and as you can see, I indicated the swing low and the swing high of this impulsive wave, and we are going to draw our Fibonacci levels for this uptrend. And to draw the Fibonacci levels, just go to this left hand toolbar over here and you choose the Fibonacci retracement option, and for uptrends you drag your tool from the swing low all the way to the swing high area like this. And like I said, you want price to start stalling at any one of these Fibonacci levels on the retracement wave, which is this wave. And as you can see, price struggled to break past this 50% Fibonacci level, and it continued to move higher in this uptrend direction. Now this is the default template of the Fibonacci tool. This is how you'll find it on TradingView, and I'm not a big fan of how this looks. It's a bit too cluttered for me, it's a bit too bright, and it's a bit of a distraction to determine the price action. So what I did is, to edit this, you just double click on it, and I made my very own template that I use, and this is the one I use, and I think you'll agree that this just looks a lot more cleaner, a lot easier to trade. As you can see, price stalled here at the 50% level, continued higher, 100%, 0%. So if you want to use the same Fibonacci levels as me and the same the same layout as I did, then just pause your video over here and you can edit your own Fibonacci tools and enter these different variables, and then you can trade along with me and use the same setup. So that is the Fibonacci tool that I use. So this is the example for an uptrend. Now an example for a downtrend, showing you guys the swing high and swing low again, is you drag your Fibonacci tool from the swing high to the swing low over there, and as you can see, let me just expand it a bit. As you can see, price stalled over here at the 61.8% Fibonacci level on this retracement wave, and it turned around and continued lower in this impulsive wave, following the preceding impulsive wave. So this is how you draw the Fibonacci tool for downtrends. And just to give you guys some two more examples, I'm gonna jump on the Australian dollar Japanese yen chart, and as you can see, indicating the swing high and swing low levels again for you guys, just to simplify it a bit. Drawing the Fibonacci tool from the swing high all the way to the swing low point over there, over here, and you'll see that price reacted at this 61.8% Fibonacci levels on this retracement wave, and it just continued lower. And you'll probably see that I added this minus 27% level and the minus 61% level as well, and both of them can act as potential target areas for price to move to. And to give you guys a conservative target price, I usually use the negative 27% area. So as you can see, price reached this area, and this would have been a successful trade to take. Now that is another example for downtrend, and let's look at this uptrend move. Again, the swing low and the swing high being shown. So for the uptrend, you just click and drag from the swing low to the swing high over there, and as you can see, again, price reacted at this 38.2% Fibonacci level, moved higher and reached our target of minus 27%. So that is how simple and easy Fibonacci levels are to use. And just remember, if you see this move, if you see this retracement, don't just immediately enter a trade when price reaches the 38% or the 50. Price can, if price breaks the 38%, it heads to the 50. If it breaks the 50, it can head to the 61 and even to the 78%. And it only becomes invalid when it reaches this 100% move or the 100% level. So then the trade becomes invalid. But anywhere before this 100% level, it's a good place to enter a long or a short setup depending on the specific trend. So that sums up Fibonacci levels in the Forex trading markets. And as you can see, these are all hidden support levels that is hard to find by the naked eye. And for downtrends, you have your resistance areas, good areas to enter sells, and these will be good areas to enter buys. So that's it for Fibonacci levels, and it's a really powerful technical analysis tool to have in your trading toolkit. And I hope you guys learned something about the Fibonacci levels, and I'll catch you guys in the next video. Bye bye. In a previous lecture where we discussed how to determine market direction, I showed you guys two ways that you can determine whether the market is on an uptrend or a downtrend, with the first being where the market makes a higher high and a higher low for an uptrend, and for a downtrend where the market makes a lower high and a lower low. Now the second way was to use moving averages, and in this lecture I'm going to expand a bit on what are moving averages and how to use them in the Forex markets. Now, moving averages are a smoothed out representation of price action, and it's used to determine market direction or the trend, whether the market is an uptrend or a downtrend. And take for example this uptrend over here, and as you'll remember, the market moves usually moves in waves like this, impulsive and corrective waves, and moving averages are just used to give a smoothed out representation of this price action over here, because it's a lot easier to determine the trend direction by simply looking at this straight line than to look at this wave of price. And both of these indicate anyway the same thing, that the market is in an upward trend. So how moving averages are calculated is by taking the average closing price of consecutive candlesticks for a certain period of time. Now, for example, let's draw 5 candlesticks, and this is just a rough drawing, guys. Each candlestick has a different closing price, and we just take the sum of the 5 candlesticks divided by the total, in this case 5, and that gives us the average closing price of this move. So let's just say, for example, the average closing price was over here. So by determining the average closing price of consecutive candlesticks for a certain time period, you can determine the moving averages. And a good thing to remember is that the bigger the moving average, the flatter and smoother the line becomes, and the slower it is to react to price action. And what I mean by bigger moving averages is, instead of using the 5 consecutive candles that I discussed, we now use 50 consecutive candles, or 100 consecutive candles, or 200, or even 200 consecutive candles. And the more candles you use, the flatter and the smoother the line becomes, and the slower it is to react to any quick price movements. And as you can see over here in this picture, the red line over here is the smallest moving average, and it follows a bit bigger moving average, more bigger, and then the blue line is the biggest moving average. So as you can see, the blue line is the smoothest line, or the smoothest moving average out of all of these moving averages, and all of these moving averages indicate an uptrend. Now there are two types of moving averages that you can use in the Forex market, and the first is the simple moving average, and the second is an exponential moving average. And the main difference between these two are how the moving averages are calculated. And without going too technical into this, the trading software that you use that automatically determines the different moving averages, so you don't have to worry about the maths behind this. But just know that simple moving averages creates a smooth line but reacts slowly to price action, therefore is better for longer time frames, where exponential moving averages creates a more accurate representation of price action and can indicate false moves in the market, therefore is better for shorter time frames. So to summarize, we use exponential moving averages for shorter time frames to determine quicker price reactions, and we use simple moving averages for bigger time frames. So scalpers and day traders prefer to use exponential moving averages, whereas swing traders and position traders usually stick with the simple moving averages because they indicate a bigger time frame. Now, how you go about using moving averages is you can use moving averages to determine the current trend direction in the market, like we discussed in an earlier video, and you can also use moving averages to determine when to enter and exit a specific trade in the market. Now, moving averages are used to indicate the trend direction, and for uptrends you can see that smaller moving averages are always above the bigger moving averages. So you first get the 9 moving average, then the 21, then the 50, and it gets bigger from there. As you can see over here, we have the 9 moving average at the top, then the 21, then the 100 moving average, and then the 200 moving averages, all of them indicating we are in an upward move. So when it goes from small to big, we are on an uptrend. Likewise for downtrends, the smaller moving averages are below the bigger moving averages, and so you'll find the 9 at the bottom, then the 21, and then your bigger moving averages like the 50, 100 or 200. So when it goes from big to small, it's on a clear downtrend. And moving average crossovers can also signal a change in trend direction and can indicate when you should enter or exit a trade. Now, as you can see over here, this is a crossover between the 100 and the 200 moving average, and this move over here is a downtrend move because it is sloping from the 200 to the 100 to the 21 and to the 9. So according to these rules, the smaller moving averages are below the bigger moving average. So this specific area, we are on a downtrend, and as you can see, the moving averages cross over each other over here, and we enter into an uptrend over here. Officially over here, when the crossover between the 100 and 200 happens, so the moving averages are on top of each other and ranging from big to small. So according to this definition, we are on a uptrend. So this is just how moving averages cross over, and usually at these crossover points over here, this is usually good indications where you can probably buy the market when the market crosses over from a downtrend into an uptrend. That can be a good indication to either enter, buy trade, or exit a current sell trade that you are in. So let me show you guys how to draw these moving averages and how to use them in the live markets. So we are on trading view again on the Euro USD time frame, and to enter the different moving averages, we just go to this indicators and strategy option over here, and you just type in moving average, and we are going to be drawing the 9, 21, 100 and the 200 moving averages. Now, like I said, for the smaller moving averages, we are going to be using the exponential moving averages, and then for our largest moving average, we are going to be using a simple moving average. So just click on the moving average exponential, and to edit it, you double click on it. Inputs, you can see the length is 9, and you go to style, you can style it any way you like, and that is the first moving average to have on your chart. To enter another one, we just simply type in moving averages again, click on the moving average again, and as you'll see, it's automatically drawn to 9. So we just type in 21 over there, change the color a bit to a blue, and there we have it. We have the 9, we have the 21. Let's enter our 100 exponential moving average. As you can see, the default is always set to 9. In this case, I just click on this 9, and we're going to set it to 100, meaning 100 consecutive candles backwards. We're going to stick to orange. I like to make it a thicker color, the bigger the moving averages becomes. I see this changed colors. Let's just make it red again. So now we have our 9, our 21 and our 100 exponential moving average, and lastly let's just add our 200 simple moving average. And again, as you can see, this is a simple moving average, and just look how differently it is to the exponential moving average over here. The exponential moving average is a better, more reliable tool to indicate the recent price movements. And let's just make this 9 or 200 simple moving average again. I'm going to make it, let's just make it black and a thick black line, and I'm going to zoom out a bit. So here's our different moving averages, guys, ranging from the 9 exponential to the 21 exponential, the 100 exponential and the 200 simple moving averages. And as you can see, we start from small and we go larger and larger. So this is a clear and very strong uptrend, and usually the further apart the moving averages are from each other, the stronger the trend becomes. So when we change time frames, for example, from 4-hour to daily, our moving averages automatically changes as well. Let's go to a weekly, and as you can see, the moving averages changes because the equation that they are calculated are changed now based on the specific time frame that we are looking at. So this is the 1-hour time frame, and it also indicates that we are on an uptrend. So that's it for moving averages, and these are also powerful tools that you can use. And moving averages can also react as support or resistance areas in the market. As you can see over here, this 9 moving average acted as a support line for price, and you can see price just bounces up and down this moving averages. But later on in this course, I'm going to give you guys a strategy how to trade these price bounces on the moving averages. So that's it for now for moving averages, and I'll see you guys in the next video. In this lecture, we will be taking a look at some of the most popular chart indicators used by Forex traders when they are performing their technical analysis on a specific chart. Now, indicators assist traders with a directional bias and provides confluence to traders' trading plans. Now, indicators also provide additional information on a chart for traders to analyze the market direction. And indicators should be used in conjunction with the overall trend of the market. So for uptrends, you can make use of certain chart indicators to assist you with trades to the upside. Likewise, for downtrends, there's also certain chart indicators that will add confluence to your trading idea for moves to the downside. Now, in this lecture, we will be taking a look at some of the most popular chart indicators, and they are the RSI, or the Relative Strength Index, the Stochastic Indicator, the MACD, or the Moving Average Convergence Divergence Indicator, Bollinger Bands, as well as moving averages that we discussed in more detail in the previous lecture. And to best show you guys how to draw these indicators on the market and how to trade them, I'm going to jump into the live market and show you guys how to analyze and draw them on your live charts. We'll be using the Euro USD chart in this lecture, and to draw our first chart indicator, the RSI, you go to this function over here called the Indicators and Strategies on your trading view, and you just type in RSI, the Relative Strength Index, and it automatically adds it to your chart like this. And you can expand it a bit, you can play around with it. And how this RSI, or Relative Strength Index, works is it helps traders to evaluate the strength of the current market conditions, and it is used to identify overbought and oversold conditions in the market. Now, as you can see, the RSI gives you this different prices at the right, and this dotted line over here, the top line indicates the 70 price mark, and the lower line indicates the 30 price level of the RSI indicator. Now, when the RSI gives a reading of 30 or lower, for example, when this purple line is trading at 30 or lower, it can indicate an oversold market, which can lead to possible price increases to the upside. And then likewise for readings of 70, as you can see over here, when the price is trading at the 70 or higher level, it can give an indication of overbought market conditions, which can lead to a possible price decrease and a move to the downside that happened over here. So that is our first major chart indicator, known as the RSI. So let me just remove it. Moving on to our second indicator. Similarly, you just type in the Stochastic Indicator and it immediately pops up over there. And just like the RSI, it automatically visualizes on the chart over here. And how the Stochastic Indicator works is it's another useful technical indicator that helps traders determine possible trend reversals in the market, and is used to measure the momentum of price action in the market. Just visualize for a moment any object that you throw up in the air. Now, before the object can turn lower, and head downwards, it must first slow down, and change in momentum must take place at the top. And this change in momentum can signal a possible trend reversal in the market. And just like the RSI indicator, the stochastic indicator also identifies overbought and oversold conditions in the market. And the stochastic indicator makes use of the 80 price range for the top line and the 20 level for the bottom dotted line. Now, when the stochastic lines like this are above the 80 reading on the stochastic, it means that the market is overbought. Likewise, when the stochastic lines are below the 20 price area of the stochastic chart pattern, then it can indicate an oversold market conditions. And this overbought and oversold conditions usually can indicate a trend reversal for the market. So that concludes our stochastic indicator. Next, we will be taking a look at the MACD chart indicator, and it's over here, and it also just automatically calculates the different levels and visualizes itself on the chart. Now, the MACD, otherwise known as the moving average convergence divergence indicator, is a tool used is a tool that makes use of different moving averages to determine and indicate a possible trend reversal in the market. Now, how you go about using this MACD is when the moving averages crosses over below the histogram like this, for example, then it's likely to indicate the start of a possible uptrend move to the upside, as shown over here. So the MACD is crossing over below the histogram. This is the histogram over here, and it can possibly signal a trend to the upside. Likewise, when the MACD lines are crossing below each other above this histogram, then it can possibly indicate a move to the downside or the start of a downtrend like this that happened over here. So the MACD and the moving averages are the only chart indicators that you should be aware of for this specific course, and in a later video when I show you guys the MACD strategy that we will be using, I will show you guys exactly how to trade this and give a more in-depth explanation of the MACD. But for now, to end off this lecture, I'm gonna draw our last chart indicator, otherwise known as the Bollinger Bands. And as you can see, this is how the Bollinger Bands is visualized in the chart. Now, Bollinger Bands are used to measure market volatility and identifies overbought or oversold conditions in the market. And you'll probably notice after now that all of these chart indicators roughly indicates overbought or oversold conditions in the market, and these conditions are used together with other chart patterns like support and resistance areas, trend lines, and triangles or wedges to create a trading plan and to execute your trades with a higher degree of accuracy. Now, when volatility is low in the market, the bands are close together, the Bollinger Bands are close together. As you can see, they are relatively close over here. This is also, the market is also consolidating a bit over here. And then when volatility picks up and increases in the market, the bands expand like it does here. As you can see, now we move from a consolidating market to an uptrend market in an aggressive way, and the Bollinger Bands expand like that. So this is a volatility indicator that is used by traders to determine the specific market direction, and these bands automatically adjust to changing market conditions. So it's automatically adjusts and changes as price action changes in the market. Now, Bollinger Bands also act as dynamic support and resistance levels in the market. For example, this lower band can act as support for price to bounce. Likewise, this upper band can act as a resistance for price to bounce off and move higher or lower depending on the trend. Now, price tends to return to the middle of the bands when it bounces off of one of the support or resistance bands. And as you can see, this is the middle band that is drawn together with the upper Bollinger Band and the lower Bollinger Band. And when price bounces off either one of these support or resistance bands like this, it tends to head back to the middle band. Like you can see over here, bounces, heads back, bounces at the supports, heads back. So that is Bollinger Bands in a nutshell, and that is the most popular chart indicators that is used by Forex traders in the market. So this was just a quick introduction into chart indicators, and like I said, I will give a more in-depth explanation of the MACD chart indicator when I will be discussing our MACD trading strategy in a later lecture in this course. So that's it for this lecture, and I'll see you guys in the next one. Thanks. Another useful technical analysis tool for you guys to have available in your trading toolkit on your way to mastering the art of Forex trading is to know all about the key psychological levels in Forex. Now, these psychological levels are certain price levels in the market that are likely to draw big market attention from central banks and financial institutions. So when these specific price levels are reached, it is likely to have some sort of movement at these levels. And key psychological levels that you'll find in the markets include weekly, monthly, yearly highs and lows, all-time highs and lows, meaning that the entire time of the existing currency pair, the highest and the lowest it's ever been are also key psychological levels where financial institutions are likely to push price to in the future. And another key psychological level to look out for are rounded numbers. Nice and rounded numbers in the market, easy numbers like 1 or 1.2 or 0.6 or 0.95, something like that. It's easy for financial institutions and central banks to use these big numbers. They don't want to struggle with numbers like 0.89573, so they tend to target these nice and round numbers for quarterly or yearly financial goals. Now, these psychological levels tend to yield a reaction by price when they are tested, and this is due to the fact that the big financial institutions and a lot of retail traders place their trades at these psychological levels. And like I said, these levels are used for its simplicity as stop and take profit levels, and adds confluence to your trading plan, meaning these are very important target areas for a lot of Forex traders and institutions out there. So it's likely for price to test these psychological levels. And some important rounded numbers in the market is as follows. For the dollar Shiffy, it's 1, nice and round, 1. Euro USD 1.1 is very important. The Australian dollar, US dollar is 0.7, and gold it's 1,600, 1,700. Usually $50 to $100 increments for gold, and it just recently reached the $2,000 milestone, and it's the highest that's gold ever been. So, and immediately when gold reached the $2,000 region, it created a lot of volatility in the market. So there was a lot of orders at that specific rounded number in the market. So let me jump into a live example of how to look out for these psychological levels and how price tends to react when they reach these levels. To show you guys the psychological levels, I'm using the Euro USD chart, and I'm going to use a daily time frame together with a 1 year time period. And I'm going to focus on mostly the rounded numbers and the psychological effect that it has on price on this specific Euro USD chart. Now, a rounded number on this Euro USD chart would be, I would say, would be 1.08. And let's just visualize that. I'm going to draw a horizontal line at 1.08, and you can even press in any coordinate value that you want on here for TradingView. And as you can see, at 1.08, that's one of the psychological levels, and immediately you can see that price bounced at this level once, twice, 3 times, and recently 4 times. So this is a very good psychological level that you can implement and add. You can add to your trading toolkit and be aware of for when price reaches this level in the future again. Now, another really good psychological level would be the 1.1 mark, and I'm going to add another over here, another horizontal line over here. Let's just edit it, 1.1, and as you can see, look how good price reacted at this level in the past over here as well. And then more recently, this was a resistance for EURUSD. Over here it was a support area, and then it broke through and continued higher. So that's another good rounded number psychological level to have. So without boring you to death, I'm just gonna quickly add some more important levels, and I'll catch you guys in a sec. Alright, so here is some of the major psychological levels on the Euro USD, and as you can see, there's quite a few of them, and the Euro USD is a really nice forex pair to trade, and it really tends to obey these psychological levels really well. So as you can see over here, this high of the year, this low point of the year, together with this rounded number is also a good psychological area, and you can see price reacted at this level and made a move higher. Then I also added the 1.12 area over here, where price tested it over here and over there again. Some few spikes up over here, and then recently it acted as a support for this move higher. The 1.14 was also a good psychological level over there and over there. A small bounce came from here. So as you can see, it was also tested over there. Then the 1.17 was tested over here. Price broke through, came back, tested it, and continued on higher up to 1.19 more recently. And as you can see, I'm just going to zoom in a bit on this pair and just look at all these spikes that's going to the 1.19 price level, and this is usually called liquidity spikes, and this is where a lot of financial institutions place sell or buy orders, and usually they push the price up into this psychological level where their orders are, and immediately when price hits this level, it immediately has a reaction, and usually it can either push the price lower or push the price higher aggressively. And as you can see over here, look at this bearish rejection candle when it touched the 1.19 psychological level. So that is the power of psychological levels. Now I added this purple psychological rounded number of 1.16 as well, and on a daily time frame it might not look like price reacted at this level, but if we zoom in a bit, I'm just gonna draw a quick rectangle at this area. So if we zoom in a bit on the 1 hour time frame to this area, let's see if price reacted to this psychological level. And let me just delete this again, and as you can see, price came up to this level, had the immediate rejection, tested it again, immediate rejection again, and broke through, and it acted as a support for this move up higher. So it might not look like it had an effect on a daily time frame, but if you zoom out to a smaller time frame, then you can see that all of these levels are likely to have some sort of effect on price in the market. So that concludes our psychological levels, and as I said, the Euro USD is a really good pair to trade these levels, and they also appear throughout the forex markets on all major currencies and all equity pairs. So keep an eye out for them, and you can make some serious money if you know how to add these psychological levels in conjunction with other technical tools that you have in your trading toolkit. So that's it for this video, and I'll see you guys in the next one. Thanks. Welcome to lesson 3 of this forex trading course, Understanding Fundamental Analysis. In lesson 2, where we took a look at the technical side of trading, we discussed the different technical analysis tools used by forex traders, how to implement them in the market to determine with a certain degree of accuracy the most likely direction for price to move. Now in lesson 3, we will be diving into the fundamental side of forex trading, which is just as important as the technical analysis side for a forex trader to have. And to start out with, we will be taking a look at the importance of fundamental analysis in the forex markets. Now, fundamental analysis is a study of economic, social and political events around the world that may affect price action in the market. And where technical analysis looks at past price movements to determine the effects on future price, fundamental analysis now looks at current as well as future economic events that can have an impact on market price in the short and long term. So with the technical side, we took a look at how the price action and the price patterns appeared in the past, and we applied those same rules to the current market conditions to determine the most likely direction for price to move in the near future. Now with the fundamental analysis, we are going to be discussing and looking at certain economic events that will act as catalysts for price to move in a certain direction in the short or long term. Now the idea behind fundamental analysis is that if a country's economic outlook is good, its currency is likely to strengthen too. So if a certain economic event comes out and it looks good, then the idea is that that specific country's currency is likely to increase as well. For example, let's say a news event in America comes out tomorrow and it is good, then it's likely for the dollar to strengthen as well. Now, to successfully incorporate fundamental analysis into your trading, you need to understand how certain news events will impact currency exchange rates. And we are going to be discussing certain news events to keep an eye out for in the next lecture. And by incorporating fundamental analysis together with your technical side of price action, you add confluence to your trading ideas, which increases your profitability. So now you don't only use your technical analysis tools that you learned, you add additional tools to your trading toolkit, and this improves your probability for successful trades as a forex trader. So that concludes the importance of fundamental analysis in the forex market. I'll see you guys in the next video. To be able to successfully apply fundamental analysis as a forex trader, you need to be aware of certain essential news announcements that are released on a regular basis in the forex market and the potential impact that each news event can have on the different currency pairs. Now, in this lecture, we will be taking a look at the most important fundamental announcements in the forex markets. And the first fundamental announcement to be aware of is the GDP, or the gross domestic product. Now, the GDP is the total monetary or market value of all the finished goods and services produced within a country's borders in a specific time frame. As a broad measure of overall domestic production, it functions as a comprehensive scorecard of a given country's economic health. The second important news release to be aware of is the CPI, or the Consumer Price Index, which is a measure that examines the weighted average of prices of a basket of consumer goods and services such as transportation, food, and medical care. It is calculated by taking price changes for each item in the predetermined basket of goods and averaging them out. Changes in the CPI are used to assess price changes associated with the cost of living in a certain country. Now, the CPI is one of the most frequently used statistics for identifying periods of inflation or deflation inside a specific country. The third important news release are interest rate decisions. Now, interest rate decisions are some of the biggest factors influencing the forex markets, and these interest rate changes are made by global central banks, and these changes are an indirect response to other economic indicators observed throughout the month, and they can potentially move the market immediately and with full force. Because surprise rate changes often have the greatest impact on traders, understanding how to correctly predict and react to these volatile moves can lead to higher profits in the forex markets. Now, the last news event that we will be discussing is the NFP, or the non-farm payroll, which takes place on the first Friday of each month. And the NFP report is a key economic indicator for the United States. It is intended to represent the total number of paid workers in the US minus farm employees, government employees, private household employees, and employees of non-profit organizations. The NFP report causes one of the largest movements of any news announcements in the forex market, and as a result, many forex traders anticipate the NFP number and the directional movement it will cause. And to view all of these essential news announcements, we will be taking a look at the Forex Factory website over here that has a calendar that is updated each day and provides you with the different news events that will happen on a specific time frame and a specific date. So you can be aware of all the different news events that is likely to happen on a specific day or week or month. So you can incorporate those news releases into your trading and be aware of them. So here we are on the Forex Factory website, and the first thing is to select your specific time frame or the time zone that you will be trading in. And for me, I'm trading from South Africa, so wherever you are trading from, it's important to use that time zone to get your specific times correct, so that you know when the specific news releases will take place. And as you can see, this is all of the news releases for the week of 9 August to the 15 August. And here is a couple of different columns to be aware of, where they show you the previous data for this specific news events, the forecasted data for the event, and as well as the actual data. Now, sometimes when the actual is better than the forecast, that means that the specific country's currency pair is likely to increase, and vice versa. When the actual is less than a forecast, then that can lead to a currency depreciation for the specific country's currency. Now, Forex Factory provides you with the specific date as well as the time of the news release and the specific currency that is going to be affected by the specific news release. For example, over here, this news release will took place on the 10th of August at 3 AM South African time, and the New Zealand currency pair is likely to be affected. And the impact column over here just gives you guys an indication of how important the specific news release is. And the yellow news releases aren't very important, and you don't have to focus on them, as well as the orange news releases. The only news releases that you will be focusing on are the red ones, because they will have the most likely have the biggest impact on the market and are the essential news announcement that we discussed. Now, here you can see this is the official cash rate or the interest rate decision for the New Zealand currency pair, which took place at 4 AM Wednesday 12 August, and this is a very important news release, and it's likely to either cause price to increase or decrease depending on how the traders anticipated or react to this actual change in the news event. So as I said, this is the forecast of the news event, and this is the previous month's news event. So it's forecasted that the interest rate will stay the same, and it did stay the same. So depending on how traders thought the news release would have gone, this will give you guys an indication of how the New Zealand currency pair is likely to react to after this news event is released. And here is the CPI for the US dollar CPI, and it's also an important news event to be aware of. And as you can see, the actual was better than the forecast, so then the US dollar was likely to increase in strength after this news announcement was released. So therefore it's important to choose your correct time zone. You don't want to see that you have an upcoming news event and then you trade it, or then you have the different time zone activated. So it's important to pick the correct time zone that you're trading in, and to be aware of the red news events and the essential news events that is discussed in this lecture. So that is the first step to correctly apply fundamental analysis in your charts and as a forex trader, and to just be aware of the specific news events that's taking place on a specific day or the week ahead, and then to trade around these news events, to incorporate them into your trading plan, and just to be aware of them. So hopefully that helps you guys with the different news events to be aware of, and I'll catch you guys in the next video. Important fundamental news announcements can play a major part in the forex and stock markets, and has the power to act as a catalyst for price to move in a certain direction depending on market sentiment, which translates to the overall market outlook by financial institutions or investors around the world, and the outlook that they have on the different financial markets. Now, to give you guys an indication of the impact that certain fundamental news announcements can have on the forex and stock markets, we are going to be taking a look at the impact that the COVID-19 or coronavirus pandemic had on the major stock markets around the world, and how you can translate those into the forex markets. To translate the impact of the fundamental news release of COVID-19, we are going to be looking at the different stock markets around the world. And to start out with, we are going to be focusing on the US stock market, otherwise known as the S&P 500 index. Now, this index tracks the 500 biggest companies in America, namely Walmart, Tesla, LinkedIn, all of those big companies. And I'm going to show you guys how the stock market behaved after the World Health Organization announced that we are now facing a global pandemic. So, as you can see, pre-coronavirus, the stock market just gradually increased, and around February, March, when it was now announced that we are in a global pandemic, just watch how the stock market rapidly increased, or some would say that a market crash took place. Most investors don't like the word market crash because it signals a lot of fear, and that is where market sentiment comes in, because fear feeds market sentiment, and the more people that feel that the stock market is going to crash, the more people or investors take money out of the stock market, and that is exactly what happened here. The more that the stock market decreased, the more people took out the investments from the stock market, and leading to a bigger decrease of the US stock market. So at around these levels over here, let me just get you guys a rough indication of the date. Around 23 March, the Federal Reserve of America and the financial institutions around the world stepped in over here, and they implemented quantitative easing and started to pump billions of dollars into the stock market to recover all of these losses and to put the end to the market crash, as you can say it. And as you can see, just how steadily market recovered over this time period, and we are now at the fundamental announcement levels of the US stock market. So that is where the Federal Reserve stepped in and basically saved the entire US stock market. And to give you guys an indication of another good index for the US stock market, we are going to compare the NASDAQ with the S&P 500. Now, the NASDAQ 100 is an index that tracks the 100 largest tech companies in America, otherwise known as, or for example, Facebook, Apple, LinkedIn, Microsoft, all of those big tech companies. And as you can see, the NASDAQ followed a similar route after the announcement of the pandemic. There was a big decline in the NASDAQ, just like what happened with the S&P 500, and where the Federal Reserve stepped in, the NASDAQ also recovered, and it's now even past its previous highs of the year. So they also saved the NASDAQ completely, and you would have even gained a lot of value to your portfolio from the previous highs of around 19 February. So let's compare some other global stock markets. For example, the Nikkei is the Japanese stock market. The FTSE 100 is a measure of the 100 companies listed on the London Stock Exchange. Then the DAX is a German stock index, and then you can put in the Dow Jones, which is an index of the 30 biggest companies in America as well. So this is all of the different indexes that tracks the stock markets around the world, and as you can see, all of them follow the same route of the S&P 500 after the news announcement of the pandemic. Each of them declined, so the stock markets around the world declined aggressively after the announcement of the coronavirus pandemic, and this is where the financial institutions or the Federal Reserves stepped in, and they recovered the stock markets of the different countries around the world. So that is just to show you guys the impact and the power that certain fundamentals can have on the market. So these big fundamental news announcements can create market crashes, and it can signal a change of market sentiment, and people then tend to, or people or investors then tend to take their money out of the stock markets and invest it in safe haven currencies or financial markets. Now, to translate this rapid decline in the S&P 500 over to the Forex markets, we are going to take a look at where did this money go, because the money didn't disappear, it only changed hands. So investors withdrew some of the money out of the stock market and they invested it into safe haven currencies. So the safe haven currencies can be the Japanese yen or the US dollar, depending on how the market sentiment is towards that specific currency. So let's take a look at the US dollar, Canadian dollar, and for the same period where the stock market declined at around this middle February mark over here, where the stock market declined aggressively, the US dollar increased aggressively. So the money changed hands from the stock market to the US dollar, which can act as a safe haven currency for investors. So that is how the stock market translates into the Forex market. And another safe haven currency would be the Japanese yen pairs. It's also a well-known safe haven currency, and similarly over here at 19-20 February, where the stock market decreased, the Japanese yen pairs increased. So remember, when the Japanese yen increase, this price action will decrease because it is the quote currency, and so that is what took place over here. The money changed hands from the stock markets to the safe haven currencies, because investors still want to invest the money of their different clients and of their own money, so they don't want to take the money completely out of the market. So the money just changed hands from the stock market into the Forex markets, and that is how you can translate the impact of big fundamental news announcements on the stock market as well as the Forex markets. So that is it for this lecture, guys, and I will see you guys in the next lesson. Thanks. In lesson 4, we will be navigating some of the different trading platforms used by Forex traders around the world to perform their technical analysis on and to execute trades from. And in this lesson, we will be focusing on two of the most popular and most widely used trading platforms by Forex traders, namely MetaTrader 4 and TradingView. And to start out with, we will be taking a look at MetaTrader 4. To download the MetaTrader 4 charting software, you can simply type in MetaTrader 4 in the Google search bar and navigate to the MetaTrader 4 website, where you can click on the MetaTrader 4 option and download it for free for any one of your devices that you'd like to trade on. Similarly, you can make use of a Forex broker that allows you to download the MetaTrader 4 charting software for Windows, iOS or Android. The specific brokerage that I use is a South African brokerage that allows me to download MetaTrader 4 directly through their website. And if your brokerage offers you this ability to download MetaTrader 4, then I highly recommend using it, as your MetaTrader 4 then gets automatically pre-populated with the different accounts that the specific brokerage offers, the different live accounts and the demo accounts for you to trade on. So after you have successfully downloaded MetaTrader 4 on your device, the next step is then to connect your trading account to the charting software, and you can either open a new account on the brokerage or log into an existing trading account that you will have already created. So let's just open a new account, and as you'll see here, my brokerage already pre-populated. It's different account types on here for a live account and a demo account. Now if you use a different brokerage, you can simply click here at add new broker, and you can search for your specific brokerage name, and you can connect your live account or your demo account to your MetaTrading 4 charting software. Now in this specific lesson, I created a demo account for educational purposes, just to give you guys an indication of how MetaTrader 4 works. Now if you want to open a chart, all you need to do is go to File, click on New Chart, and then select any of these options. Let's just click on the Euro USD, and here you have your chart. And this chart you can maximize, or you can play around with it and customize the size just like you want. So another way to open a chart is to make use of this Market Watch window on your left, and if it's not already shown to you guys, you can just click on this Market Watch tab above here, and all of the different symbols is populated in this Market Watch. So to open this pound USD pair, for example, just right click on it and click on chart window, and then it automatically opens the specific symbol for you guys. Now if there's a symbol on the Market Watch that you want to trade, but it's not on here on the Market Watch, and you want to add it to the Market Watch, just right click and go to symbols, and then select any of these symbols that your specific brokerage offers for you to trade with. And I'm gonna add this Brent oil symbol to my Market Watch, and you can just click on show and then close this tab. As you can see here at the bottom, there's the symbol that I added, and now you're able to trade the specific symbol that wasn't initially on the Market Watch. So that is how you guys can open a new chart. And if you want to change the display of this chart from this black and green display, the first thing that we'll do is we are going to change the bar charts to candlesticks, and you can either click the tab above here for candlesticks, or you can right click on the chart, go to properties, common, and then select candlesticks for your chart. Now to give this chart a different look than the current black and green view, you can right click again, go to properties, and in my videos I will be making use of a color scheme, the black on white color scheme, with a bull candle, with a greenish bull candle and a red bear candle, and you just click on OK. Now to view this, we're going to zoom in a bit on the chart, and as you can see, here is all the different candlesticks and the different colors for each specific bearish and bullish candlestick shown in the market. Now when you add a different currency pair to the layout, let's just open the Euro USD for example, and a new chart window appears. It automatically takes you back to that initial black and green display. So without you having to follow the same steps of having to change the properties every time, MetaTrader 4 allows you to create a specific template that you can use on all of the different symbols that you like to trade. And to make a template, you just right click on the specific chart, go to templates and select save template. Now I'm just gonna save this template as lesson, save it. So if you want to use this template that you saved, we're just gonna click on this Euro USD chart once more, right click, go to template and select the lesson template over here. Similarly, you can select this tab over here for the templates, and you can select the different templates that you want for the specific chart of your choice. Now just a quick tip that I can give you guys. So instead of choosing a template each time you open a new chart, you can save this template as a default template. So let's just save it as a default. So then whenever you open a new chart, for example the USD CAD, it automatically goes to the default template. So it saves you a lot of time when you trade different currency pairs. And in order to give you guys different views for the different charts, you can go to the window tab above here. You can select tile windows, cascade windows, tile horizontally, so you can trade like this, or you can tile it vertically, and it allows you to trade the markets in whichever fashion you want. So let's just maximize this specific chart for a moment. To play around with how you view this chart, you can zoom in and out of the chart like you want, and you can make use of these two buttons over here. The first button just automatically scrolls the chart to the current candlestick. So if we deselect this, you can move around with it, but if we select it, then it automatically scrolls you to the current candlestick being formed. So as you can see, it automatically takes you back to that candlestick, and you can even select this second tab, which just shifts the start of the candlesticks a bit to the left, so it's not so close to this vertical scale over here, which you can even drag a bit and play around with it. So whichever method works for you best, you can then implement in your market styles. Now the different time frames that you can implement for your trading is shown on this quick tab over here with the minutes, the hour time frames, hour forward, the dailies. So you can select any time frame that you feel comfortable with, and as well as the different trading tools that you want to make use of is also pre-populated on this quick tab above here. For example, the vertical line, you can just click and add it, or horizontal line similarly, and to edit this, any of the trading tools, just double click on it. So this little box appears at the right and at the left, and you right click on horizontal line properties, and you can change the style of the specific line. You can make it black, you can change the line type, and you can even change the thickness of the line. So you can play around with it a bit. Similarly for the Fibonacci tools, just click and drag to wherever you'd like, from a swing high to the swing low, or vice versa. And on the right here you can see all of the different Fibonacci levels already pre-populated for you guys. And if you like to add another additional trading tool to this quick bar over here, just right click anywhere, then go to customize, and you can add any one of these available tools. I'm just going to add the rectangular trading tool. Click on insert, close, and then you can draw your support or resistance areas a bit more clearly in the market wherever you like. And then to get rid of all of these technical tools, you just right click, go to object list over here, and then select the specific technical tool that you want to delete. I'm just going to clear all of them, and as you can see, your chart is now clean once more. And to insert some indicators to help you guys with your trades, you can either go to insert above here, go to indicators. Let's just insert the Bollinger Bands. This is where you can enter the different variables that you like. We're just going to stick to the defaults. So there's your Bollinger Bands. Likewise, you can go to this Navigator tab window over here at the bottom, click on the indicators, and here's all of the different indicators that you can use on MetaTrader 4. So let's insert some moving averages. Just go to trend, moving averages, double click on moving averages, and you can select any period you like. Let's put in a 21 exponential moving average. Similarly, you can select the simple moving average. Likewise, you can change the style of the moving average, the thickness, and you can play around with it, and there's the specific moving average. And all of this you can again save on a template, and you can use these exact same moving averages and Bollinger Bands setups for a different chart type that you want to view. So to get rid of all of these indicators, you can simply right click, go to indicator list over here, and then select. So you can either edit or delete the specific indicator. I'm just going to delete all of them again to give myself a clean chart once more. Now another thing that comes handy is to use this crosshair tool to measure certain aspects of your chart. To make use of it, you can just click and drag to a certain level in the chart. So it comes with three variables. So the first, indicating the 12, is the number of candles to the specific length where you want to measure it. The second is the pip value. So instead of 100, you should just read it as 10 pips. So the third one is a decimal place, and then the last variable shown, the 1.32617, is where you are currently hovering your crosshair. So that's also a handy tool to know. So moving on to placing your orders, you can just click on the new order over here, and as you can see, this window appears, and you can select the specific symbol that you'd like to trade. You can select your volume, which is the different lot sizes we discussed earlier in the lecture, your stop loss, your take profit, which we'll dive into more detail later on in this course, and as well as the market execution. So you can just sell or buy at market. So let me just quickly sell at market, and as you can see, this order is immediately executed over here. And to get an indication of how this specific order or trade is doing, just go to this terminal window over here, click on the terminal tab, and here you have the specific trade that you're in. So currently we are at minus $15 profit on this demo account. You can see the specific variables for this trade. It was a sell type, the size, the symbol, price, and to modify this specific trade, we can just double click over here, and we can enter a specific stop loss for the sell trade. Let me just enter a quick example for you guys, and you can select the modify tool, and there you have your stop loss and your take profit levels. But we'll dive into some more detail later on in this course, exactly how these levels work and how to draw them. And if you want to adjust your stop loss, you can simply click on the stop loss and you can drag it to wherever you like and release it, and then that's your new stop loss area. Similarly for your take profit area, click and drag and it automatically adjusts. So then to close this trade, you simply click on this closure point over here and you close it. And to view the different trades, your trading history that you take, you just go to your account history tab over here, and here you can see the different trades that you executed. So this is the USD CAD trade that we just took, and there's the different trades, each showing you the symbol, the price, and stop loss and take profit levels, as well as the time. And this helps you keep track of the different trades that you took, and this is what we're going to be making use of later on in this course, when we are going to be discussing how to use a trading journal. So that sums up MetaTrader 4, and that's just a quick overview of getting to know MetaTrader 4, how to execute trades, how to modify trades, and how to close your trades. Similarly, how to draw the different trading tools and make use of the different currency symbols. So that is the first trading platform that we will be making use of. And just like you can download MetaTrader 4 to trade on your laptop or on your computer, you can also download the MetaTrader 4 app on your phone to execute and close trades from. So that's it for MetaTrader 4, and I'll see you guys in the next lecture when we discuss the TradingView trading platform. Thanks. The second trading platform that we will be taking a look at in this course is called TradingView. Now, TradingView is another extremely popular trading platform that's used by millions of traders around the world. It's a completely free trading platform to use to perform all of your market analysis on. Now, you've probably noticed that on the different technical analysis lectures, I've been using TradingView to perform all of my analysis on, and that is because TradingView is my personal trading platform of choice, and I've been using TradingView for a number of years now to perform all of my analysis on. And I believe TradingView is a lot more modern and user-friendly than MetaTrader 4, and it just works a lot better for me. And where MetaTrader 4 is a bit more focused on the currency pairs, TradingView offers a lot wider range of markets for you to analyze and make use of. So to view the different markets, you can simply go to the Markets tab over here, and you can see that TradingView offers you cryptocurrencies, regular currencies, stocks, indices, futures, and even bonds to make use of and to analyze. So we will just be sticking to the currency market or the Forex market for this course. And another very cool thing about TradingView is it's a very good community-based trading platform, and it allows you to connect with traders around the world to view their different trading ideas. And to do that, you can simply go to the Ideas tab over here and Asset Class and Currencies for this course. So to view the different Forex ideas from traders all around the world, you can go through each idea that is shared by a trader around the world, and you can even create your own trading idea and set up and share it with the different communities on TradingView, and you can build quite a following for yourself and get some valuable feedback as well. So the only downside I would say about TradingView is they are a bit too limited with the different brokers that they offer. So if you go to the Brokers tab over here, they only offer you the OANDA and the FXCM brokerage for you to execute your trades with, where MetaTrader 4 allows you to connect with any Forex broker around the world to place your trades with. TradingView only offers you this OANDA and FXCM brokerage. So if any one of these brokerages are your Forex brokerage of choice, then you can simply stick to TradingView alone. You don't even need to make use of MetaTrader 4. You can do all of your market analysis on here, and you can place your trades on here as well. So let's continue now to head over to our different charts, so how you can then proceed to perform your different analysis on your charts. So the first thing that you're probably wondering is how to choose the different currency pairs to trade on, and to do that you can simply type in your specific currency pair that you want to look at over here at the left hand tab, and you can search the different currency pairs. So I'm just going to delete this search option, and as you can see, all of the different currency pairs that is available for you to trade on, you can select any one of them to make use of. So let's just go to this pound Australian dollar pair, and you can click on it, and it gives you the specific British pound Australian dollar currency pair that you can make use of. Now, to trade on a different time frame, you can simply select your time frame of choice to the right of this currency symbol. You can click on this drop down list and choose any time frame that you like to trade with. TradingView also offers you a lot wider variety of time frames to make use of. So you can see there's a 8-hour, a 3-hour, and even a 2-hour option, and you can even create your own unique time frame of choice that you feel comfortable with. So to play around with this visual look of the chart, you can go to this candlestick option at the top. You can create bar tabs, you can go to hollow candles, or you can even visualize your price action as a line chart. However, we will be sticking to candlesticks in this course, and you can change the look of this chart as well by either clicking on this chart properties or right clicking on your chart and going to settings. So at this symbol option over here, you can then proceed to change the colors of your candlestick. So let's just make it yellow and blue for fun. So you can see the different candlesticks are now appearing as yellow and blue with the different borders and wicks as well. So then if you want to change the background of your different chart styles, you can go to background. It's currently set to white. You can make it orange, you can make it green, red, any color that you want. I'm just going to stick with the white background. Then these subtle vertical grid lines you can also change, so you can give it different colors, make the vertical and the horizontal lines different colors as well, so whatever works best for you. Me personally, I like to make my grid lines white so that they disappear in the background, so that I can just purely focus on the price action at hand. So then you can even go to the events tab over here, and you can select the different economic events that you would like to be displayed on your chart. So let's just go back to our original chart layout and go back to the red and green candlesticks. So as you can see at the right corner over here, this is the different economic calendar dates that are displayed. So if you click on one of these options, you can see the upcoming economic news or the fundamental events that is going to affect the specific pound Australian dollar currency pair. So whenever you change to a different currency, then the economic news update as well. So that is then just some background into the how you can make use of the different currency pairs. Now to proceed to your technical analysis tools, they are all over here on this left hand tab on Trading View. And to draw your trend line, you can simply click on the trend line and you can draw it on the market. Let's draw another one over here, and to make a channel you can simply click on your specific trend line, go to this option over here, clone or copy. I like to clone it. Then you can simply drag it to wherever you want, and as you can see we have a bearish channel over here. Now to edit the specific trend line, you can simply double click, you can make it a different color. Let's just make it blue, and you can give it a different visibility as well. So you can play around with it, and there's a lot of freedom for you to make use of Trading View for your different technical tools as well. So another good tool that I use is this horizontal line tool. So you can simply place this horizontal line tool in the market wherever you want and drag it to your specific price level. Again, just changing the appearance as well on Trading View. Then another tool that I like to use is this horizontal rate tool, and you can click on anywhere in the chart, drag it to wherever you want to, and I like to use this horizontal rate tool to indicate important psychological levels in the market. So I'm just going to click on this psychological level of 2 in the market. So I know that if price goes to this specific level in the market, then I already know this clear level in the market from this horizontal rate tool. Then leading us to our next option over here, this is more options that you can make use of on TradingView. Now personally I don't use the majority of these options. I only use this Fibonacci retracement to draw my different Fibonacci levels, and you can simply click and drag then on the chart to display your different Fibonacci levels. And during the Fibonacci lecture I told you guys that I don't like this default setup, and I created my own unique template that I make use of for Fibonacci levels, and this is just a lot cleaner and it's not so cluttered on your chart. And if you want to make use of this exact same Fibonacci levels that I use, then you can simply pause the video. You can populate your own Fibonacci retracement with these different levels as well. So that is then our Fibonacci levels. So you can go to this option as well. You can play around with the brush tool. You can color in your chart a bit. Another tool that I make use of is this rectangular tool to indicate important support and resistance areas in the market. And just another quick tool that I forgot to mention is this parallel channel tool that I show you in the support and resistance lecture in this course, that you can indicate the major support and resistance areas in the market as well. Again, you can just create your own unique style for this parallel channel as well. Then going back to this tool over here, I also like the ellipse option. So just to highlight an important candlestick to be aware of possible entry orders for me to take a trade, and you can just create your own unique style again over here. Then you can even add some text to your chart. Let's just quickly add some text over here, and let's call this the swing eye of this British pound Australian dollar chart, and it appears like this, which again you can edit and visualize in a different fashion. So this is a lot of user-friendly tools that you can use and you can edit, and there's a lot of freedom for you to play around with on TradingView to create the best possible technical analysis that's going to improve your trading. Then leading us to this different patterns option over here. You can add your different butterfly patterns that we aren't going to discuss in this course. You can add your head and shoulders pattern. You can visualize your different head and shoulders in the market, just to quickly give you guys an indication of how this will look. Something like this you can then visualize in the market. However, I don't use any one of these options for my trading, and then for the different the ghost trades that we will discuss later on in this course, I'm going to make use of this long and short position. And you can even add different emojis if you want to, just for fun. And then lastly, this leads us to our measuring tool. So you can click on this measuring tool and you can measure the price action from anywhere that you'd like. So let's say from over there to over here. So this is then this specific price action took 31 candlesticks or 43 days, and it was a total move of 1,397 pips. So from this candlestick over here to this placement over here was a total of almost 1,400 pips. So you can also measure then some price action in the market. So if you want to remove all of this analysis but you don't want to delete it, you can just simply click on this eyeball over here or this hide all drawing tools. Click on it and it removes all of the different technical analysis, so you can just visualize the price action a bit more clearer, and you can even delete your complete technical analysis as well by pressing on this trash bin as well. So that is then our technical analysis tools, leading us to our different market indicators that you can make use of. And to do that, you can go to this indicators and strategies option, click on the different indicators you want. So let's just go to moving averages, click on your moving average, to edit the moving average, simply double click on it, give it a different input. So let's make this the 50 moving average. So there you have your 50 moving average, and let's add some other indicators as well, the RSI or the relative strength index, and let's add the MACD as well to this chart. So here you have your different indicators that you can make use of to assist you with your technical analysis. And again, you can edit the different indicators to your liking. So just like with MetaTrader 4, you can create your very own template that saves this moving average and the two different indicators. And to do that, you just go to your indicator template. You can go to save indicator template, and you can create your own template that you can just save for this for future use. So let's just call it template, save, and you can make use of this template whenever you want to use this exact same template on a different currency pair. So let's just delete all of these indicators real quickly. And if you want to create a different watch list or a different so the different watch lists for the different currency pairs that you want to be focusing on, you can simply add your specific currency pair to this watch list over here, and it can create your own unique watch list that you can make use of in the market. And you can simply just browse through the different currency pairs quickly, and you can see all of your different analysis being performed on the chart to assist you with your trading. So that is then our technical tools, the different currencies, the time frames, the indicators, and to share your trading ideas, you can either take a snapshot or a screenshot of this chart. You can simply click on this chart, on this option. It creates its own URL for you. You can share it on Twitter, and you can even save this image and you can share it with your trading community or with your fellow Forex traders, or with your mom or dad, whichever you like to do. And then lastly, you can even share your trading idea by publishing this trading idea, and let's just call it trading idea for kicks, and you can give it its own description, and you can say whether it's a long or short position, and you can simply publish this trading idea to the trading community on TradingView. So another very useful tool that I also like to make use of is this bar replay tool, which I'm going to be making use of a lot throughout this course. So you can simply click on this bar replay tool, and you can take this tool to wherever you want to. So let's just go to the 16th of June, and it takes you to that current price action in the market, as well as the relevant news events that took place during that specific time in the market. And you can simply perform some technical analysis on this chart, and you can test your trading ideas on this specific date in the market, and you can perform back testing as well, that we're also going to be getting into more detail later on in this course. And then a last useful tool on TradingView that I like to use is this create alert option. So yeah, so I just probably should exit this replay mode then real quickly. So to make use of this, you can simply click on create alert, and I use this to indicate my take profit and stop loss levels, so that I don't have to monitor my charts the whole time. I can simply create an alert at my exact take profit and stop loss level, and it notifies me or sends me an email on my phone, and I know when I receive the notification, my trade either closed in profit or it closed in a loss. So that is then how you can make use of TradingView. And if you simply want to execute the trade, you can click on one of these options above over here, and my brokerage that I use isn't connected to TradingView, but if you make use of the Oanda or FXCM brokerage, then you can simply connect it to your TradingView, and then you can easily execute trades on TradingView, and you don't even have to make use of MetaTrader 4 then. So that concludes this lecture on TradingView, and I highly recommend you try it out for yourself. It's a very user-friendly tool, and it's a very powerful trading platform for you to analyze all of your different charts. And like I said, I've been using it for a few years now, and I have no complaints using TradingView. So I perform all of my market analysis on TradingView, and I simply execute my trades then through MetaTrader 4, either on my computer or on the MetaTrader 4 app on my phone.